Again. Don't look at the log. Look at where you want to go.
When you work with someone who knows a lot and cares even more,
I got this.
you're unstoppable.
Here's where I want to go.
Great, let's get started.
At Truist, we believe the same is true for banking.
Should be 50 points cut. But a little bit behind.
Breaking news it is. Welcome to Power Lunch, ladies and gentlemen. Alongside Kelly Evans, I'm Tyler Matheson. From Washington today, we're just minutes until the Fed's decision, Kelly, on interest rates.
The markets are clearly in wait-and-see mode, literally almost unchanged for the S&P. The Dow.
Really do not want too much.
More importantly, how will Chair Powell explain and set expectations for what the Fed plans to do next, especially as it relates
I'd like to
to
see the
how
Fed
many
get out of the
more
way,
cuts are
so
in the pipeline.
I want to see them get to
Very
neutral as
curious
quickly as
about this. We've
possible,
talked a lot. There are
in
about
the
2
short
full
term.
points of cuts in the
But
pipeline,
maybe,
over the
maybe what I
medium-term
really want
horizon.
is
If
the
that's
Fed
not their
to
plan and the bond market needs to meet their kind of higher
completely
mentality,
scare
that's
us so I
fine.
get a better
If it is
buying
the plan,
opportunity.
then it could signal, as we've been discussing,
going into the
a
election.
weaker economy than we previously thought.
Let's get right to our all-star panel as we are just minutes
I just think what would be best for the market is that. But, I'm a long-term investor, so cheaper prices is good.
Som of New Century Advisors back in this hour, and Jim Caron of Morgan Stanley Investment Management. Let me let you, Claudia, tee up the conversation here. You believe that the Fed should cut rates.
Any questions in the chat here? For some reason, my CNBC is not showing up. Only the sound is, which is a little annoying.
That the labor market has cooled off relative to where we were even back in July. So
all right, we're just going to use the
that's
sound.
the reason to start
Look at
moving
Bloomberg
maybe
News.
a little bit
I can
more,
pull up any stocks
really,
you guys think might benefit. Listen,
really
I think it's small cap
to get a game
season.
plan from Jay Powell today as to where
do I think large caps are going to do poorly? No.
Because this is going to be an
but I think that small caps are going to
conversation
outperform.
What's the next reg cut?
Which would
How
be
big
quite
is it? When
nice.
is it? And we need some guidance, so we're not always in this guessing game right down to the wire.
David, make the case for a quarter point instead of a half point.
Viewer on YouTube.
I think the economy is fine, and I think the issue here is the messaging. I think it's very important that Jay Powell say,
okay,
look,
so thanks for coming over. Again, I'm live on YouTube.
Down, but the economy itself is strong.
If
so
you ask me questions on TikTok, I can
bring it down
answer
25
those
basis
as well.
points. I think we might see three cuts this year still. So I think they can bring it down.
So Jeffrey Gundlach, pretty much the bond guru, thinks that we're going to cut 125 basis points by the end of the year.
Jim,
that's pretty aggressive. That gets us close to
how
neutral.
Do they square an economy growing just
I don't think that's going to be the case.
Concern about inflation, we've heard
Jeffrey
both
Gundlach
candidates
is
mention,
the bond
and what they're hearing from constituents. How do they message that?
Now, if the Fed cuts 100 plus basis points, what's going to do better?
Basis points, and one of the risks is
I'd say equities for sure.
Could unanchor inflation.
What's up, Lush?
We
Good to see you.
Saw PPI, we saw CPI data come out. The inflation data it's coming down. But, there is some
on YouTube, but the only thing with YouTube is unless you have YouTube Premium, you can't watch a live or watch a video and also do whatever else you want on the phone. So I understand if you guys want to stay here.
Basis points, that it could be that the unemployment rate accelerates higher and that creates a bigger problem down the road. But the other side of the
cuts rates by half point in decisive bid to defend economy. Okay, so how is the market responding? That is not what I expected.
They basically signal to the market that they're very aggressive and that this could create a bigger problem down the road. So,
thanks, Lush.
In my view, I think 25 basis points on a risk-adjusted basis is more warranted, but that doesn't mean that a very good case could be made for 50.
All right, Jim, thanks very much. We'll come back to you in a very short time, but we are just seconds now away from the Fed's decision on interest rates, and for that, let's go to
50 basis points. We are ripping.
50 basis points, the Federal Reserve cutting interest rates by 50 basis points to a new range
That's
of
decisive.
4.75% to 5%. There was
now we're up
one
a percent.
Fed Governor Michelle Bowman preferring to cut by 25, but 11 voting in favor of 50. It might have been
11 to 1.
At the end of this report.
That is pretty
the statement says the committee
convincing.
Will consider additional adjustments to policy based on the
Bowman
data,
dissenting.
the outlook, and the balance of risk. The summary of economic
so
projections.
being upper percent, I kind of want to see what this is doing to my portfolio.
This year, for a total of 100 this year, that
that's
would bring the median down to 4.4%.
I don't think anyone can say that's not
50 basis points from where we are
bold.
right
Now,
now. Another 100 basis points of cuts expected through next year,
what
bringing the rate
Powell
down to
says is very
3.4%.
important.
All of that a bit above where the market is priced. And the new long-run rate would hit 2.9%.
If he
That's
sounds
up a tick by the year
concerned, if he sounds
2026.
anything
The
but
statement now says the Fed is
super
firmly
dovish,
committed to
this
supporting
could
both
unwind
maximum
all
employment
gains,
and
we could
the
literally
2%
end
inflation
negative.
target. Before and for many months before this, the Fed had relied solely on saying it was focused on the inflation target. The committee has gained greater confidence, the statement said, that inflation is moving to that 2%
Now the
target.
NASDAQ is up,
And
so that's
both
interesting.
sides
So
of the
like the
mandate
question
now are set to
is,
be roughly in balance.
does,
On the
yeah,
economic
my
description,
port
the
just
economies continue to expand, it says, at a
jumped
solid
2%,
pace.
which
Job
I
gains, however, have
absolutely
slowed.
love.
Inflation making further progress towards 2%, but remains elevated.
I mean,
It's
would I
seen
like
declining to
stocks on a discount?
2.3%
Yeah,
this
but
year,
you know,
2.1
being
next
up
year,
2%
and hitting
because
the target
Jay
2%
Powell
by 2026.
delivers
Unemployment, the
a 50
outlook for
point
unemployment
basis
did
cut
tick up. I think
is
that's
fun for the
important to
short
what the
term.
Fed said here and what it did. Up 0.4 to 4.4%, 2 ticks higher than it is right now. Growth pegged at 2%, slightly above the 1.8 potential, well into 2027. Now, 9 officials in the dot plot wanted to do 75 basis points or less this year, and 10 wanted to do 100 or more. So it may have been a very close call as to what was actually wanted around the table in terms of 25 or 50 today, but they decided ultimately with 11 voting in favor of the 50 basis point rate cut. Tyler.
All right, Steve, stick around as we get back to our panel for some reaction. Claudia, you were the one who said 50 basis point cut, and that's what happened here. Clearly, maybe more emphasis on what's going on in the labor market than on inflation.
So
right.
what do we think,
Absolutely
guys?
a vote for
What
the dual
is
mandate.
the
And so
initial
trying to
thoughts of
protect
everyone?
maximum employment. You know, things are good right now. They're not
Yeah, now we're
moving
unwinding. We're only up
in a
60
good direction with the
bips.
labor market, but that's why you
I
get
thought
out
that
ahead
initial
of it.
thought
So this
was
is a
too
risk
aggressive.
management, and it's showing that the Fed is taking the
Market
risk
seems to be
on
agreeing.
the labor
Ooh,
market side
Loosh,
very
50 is a lot.
seriously,
I
and
think
that
it's a behind
also
the curve
shows up in
move.
the projections.
His words are
Right, they
important
are
than the cut.
trying
I
to move.
agree.
This is not the last
He's got to be
cut. So
confident. He's
it's
got to say, hey, listen,
it's a really important recognition
we
of what
we
we've been
moved
learning
quick
about the
to
labor
get up
market,
here.
and the
We're going
Fed
to
is
move
reacting
So,
to it.
as
David
quickly
Kelly,
as we need
opening
to.
big,
But
and you think
this is
that
not based
another,
on data.
well,
Or, I mean,
you
it's
said
obviously based
that
on
by
data.
the
You
end of the
wouldn't
year
say
we
that.
would be
But
three-quarters of a
this
point
is
lower than we are today. That
not
would
based on
imply
fear,
then
however you
that
can
there would be
articulate that.
at least 2 more cuts of 25 basis points, or at least one.
Yeah, no, I think we probably will get two at this stage. I mean, I would have preferred they went 25 basis
Now,
points
what
today.
does this
Obviously,
do
it's a
to
very
the
close
carry
call in
trade?
futures
That is
markets.
the
But the
question.
important thing to
Because we got
recognize is that
the
cutting
dollar
interest rates
collapsing now,
at
it
the
looks
start
like.
doesn't stimulate the economy at all. There is a J-curve effect. It actually slows the economy because people begin to anticipate those lower rates, so they want to wait for lower rates. It tells people that the Fed is scared about unemployment. I don't think they really should be, but that's the message
Like
it
a
gives,
yen
so it
over
undermines
dollar.
confidence.
No,
The reason I
I'm
thought,
on dollar over
bringing
yen.
rates down from a high level is like, bringing a piano down as a flight of stairs. You've got to do it very carefully and very slowly. That would be the right way to do it. And I'm a little worried that they've started off in a rush here. But I do think this economy is strong enough to deal with it. I think we will, next year I think we'll get 2% growth, inflation 2%, unemployment close to 4%. So I think it's still a healthy, strong economy.
Does it risk it in any way, Jim, reigniting inflation?
Look, I mean, to some degree, it certainly could, but it really depends on what happens to the labor markets. Look, I see this as a three-dimensional problem for the Fed. Number one, where do they see the neutral policy rate being? Number two, how quickly do they want to get there? And number three, what is the employment situation? Is the employment situation going to deteriorate more quickly? What the Fed is signaling today is that they are very concerned that the unemployment rate could start to accelerate higher. So to me, yes, this could be something that.
So, an interesting little tidbit for everyone. Also, Loosh, how is my sound?
But what it does
Hearing
signal,
CNBC on
that they are
YouTube.
worried that there could be a faster pace of layoffs and job losses and things like that. So I think the markets, while they may be happy that the Fed cut interest rates, they might have to ask the question as why they're going as fast as they're going and what is the cause for that concern. So I think it is a little bit of a double-edged sword here.
Claudia, what about that very interesting point that David made, and that is that,
saw at the end
that perversely,
the end drops,
sometimes cutting interest rates can slow down activity as people wait for interest rates to go even lower.
Right. Well, the first thing I'd say is we know from this cycle already that the comparisons back to history are going to be really tricky. We haven't had a kind of easing cycle like what the Fed has started us into in a very long time. So and we've had a lot of what are Fed interest rates even doing in this cycle. So I think there is that issue.
So a
Now,
stock that
markets,
I'm going to be
this
adding
will be
to,
a very
guys, is
important part of the press
NNDM.
conference today, is this
Now it
messaging from
is
Powell about going forward with interest rates. You can
Israeli
get that
3D
quote-unquote
printing
forward
company,
guidance and
but
have
they
the
have
market
so
rates
much
look out ahead. And this is a Fed that with a
cash.
50 basis points said we are going
I
to
think,
do this.
and to the
And we are
Israeli
going to be not necessarily
it's up
aggressive, but we're really
4%
going to
today.
move on it. And I think that can show up
It's
in
up
market
4%
rates
after
and
the
then
move.
help with that, behavior changing.
David, one
But I
aspect
didn't get my
I'm
bid
very
filled.
curious about how
So
markets and banks
that's
react
one on my
is
radar.
Americans have actually been making a lot of money on high rates
It's a
if they have their
George,
money in money market funds, if they hold
that's a
treasuries and
George
so
favorite.
forth. Taking things down a half point doesn't change a lot, but it might just be enough. And I'm curious what your take is to kind of start moving money around and at the margin take a few dollars out of what's been a very lucrative place to park cash.
Well, I don't think it'll have that effect. I mean, I
No
do
comments
think that
in
it
here,
squeezes
huh?
the income of older Americans just a bit. But what it does, I think it will introduce the question of, well, how much is the economy slowing? And that is not necessarily good for the equity market, no matter how much it, positively responds
Also,
to
I
what they've
added
just
to
done
some
today.
HEPs.
I mean,
I
as I
haven't
said,
told
I
you
think the
guys yet
economy is strong
that,
enough to
but I'm just sizing
handle
up in my
this.
favorite name.
But overall, I
For
think
small cap
the
to
messaging is
be,
very important from here. So in the
7%
press
of my
conference, it's
portfolio
very
is pretty
important that Jay
significant.
Powell stress
I
the
think
level of comfort with inflation.
everyone
Look,
can
we've got
agree
lower
on that.
gasoline prices down 70 cents year over year. We feel good about growth, but honestly,
So that's a
inflation's
pretty
doing
high
even better than
conviction
we thought
trade
it
I
was. So
have.
that's why we can move today. If he stresses progress in inflation rather than worries about unemployment, then he'll do the economy a great service, and I think that'll make this a much safer cut.
Steve, Claudia made the point. I invite you to pick up on whatever thought or tangent you would like. But Claudia made the point that this is a different.
I mean, these
different
small caps
circumstance. We
emerging
haven't
in
had this
markets,
kind
like
of
I really
initiation of a
do
rate
think
cutting cycle in a long time. Certainly not under these kinds of
it's
circumstances. When we've had
sort
rate
of
cutting cycles
it's
before,
time
it's
for
been in
them
response
to
to
start doing well.
economic crises like the pandemic, like the financial crisis in 2007, 2008, 2009. Here, it's a different set of circumstances.
NNDM's a good play,
Economy's pretty
Luciano.
good. Very little sort of
Or
idea that
HEPs.
a recession is
What's up,
on the
Bakari?
horizon. Talk to me
What's
through
your
that.
question?
Talk me through that, if you wouldn't mind.
Well, Claudia studied history. That's why she's famous in our world.
Bakari, if you have like
I've
specific
studied
questions,
history
come
maybe a
over
little
to
bit
my
less,
YouTube.
and I can tell you with experience that nothing works, Tyler, in terms of comparing this to any of the cycles.
I can't accept a guest. I'm sorry,
lack of analogs
because I wouldn't
for the
even
world
be
we're
able
in
to
right
really
now.
hear you.
Fundamentally, it seems like what the Fed
Because I'm live on
decided
YouTube. But if you come in the
is
YouTube
this was
chat,
really a
you can
transitory
type out
supply
much
shock,
longer
somewhat
comments,
exacerbated
and I can look
by
at what
somewhat loose monetary
you'd
policy,
like me to.
somewhat loose deficit spending. But if you hear the Fed talk now, much of the blame ends
Small
up being
caps and emerging
on the
markets.
supply side shock.
Yeah, I mean, when the
think
dollar
will
is
itself
weak,
out. A lot
it
of
helps
that
small
created
caps.
a background of
It helps
why
emerging
the heck are
markets.
we so
It helps
high if it was a
international
supply
businesses.
shock, and it's largely worked itself out. We have another half a point, maybe a full point to go, depending upon how you want to measure it. And we can get that done by being restrictive, but we don't have to be this restrictive. What Powell took, I would say, Tyler, is 50 basis points of what could be an easy 100, 150 that the Fed can take, and do so while remaining restrictive and not even be in danger of sort of further stimulating the economy. The game now is going to be restraining the market and its forward pricing of where the Fed is going.
What is the dollar index
that
again?
forward pricing,
DYX?
Tyler, as you know, works itself into the real economy
DXY.
through the floating rate mechanism that allows businesses to go out and borrow at tomorrow's yield. And that's where the stimulus comes from. So now we begin a game of the Fed on top of the horse, holding the reins and figuring out how much to let out the reins
is
and how much
100
to
now.
pull back. Right now,
This
they
is
let
the
it out
low
50.
going back
It's
to
a great point, Steve, to emphasize,
last
that's
December.
where a lot of this will hit the real economy. And in some ways, that
That's
move's already
pretty
been
crazy
made,
to
and
me.
we'll see how markets react. And on that point, Jim Karen, I just wanted to point out, if you told me that they were going to cut 50 and asked me what I thought the stock market reaction would be, I could go either way. The reaction so far has been positive, though, and that seems to be a sign that they're taking the kind of this will be stimulative on the margin and keep the soft landing intact story, as opposed to the we're at the beginning, like Tyler was saying, of a recession, and as we've seen with past
the
cuts
market
to the
thinks
side.
it's positive, and you know, it
I
was up
think the market's
1%.
signaling
Now it's
that
only up
this
30
is a
bips.
step in the right direction for the soft landing. I want to pick up on one thing that Steve Leisman said, because I think the eye on the prize here, what we need to be focusing on is where the terminal rate is. Where they
Now,
begin
I think
this
the
journey
obvious
of cutting
question
interest
is,
rates
how
is
does
an
this
interesting
affect
point to talk about today. But what the
politics
markets are
going
going to
into the
focus on
election, right?
ultimately is
So
where do they end.
now you have
So
a
the faster
Fed
they
that's
start
cutting
cutting
into an
today,
election.
that means they might go slower later on. In other
Is
words, they
that,
get this move done with, and we
is
get
there
this
any legs to
stimulus
say
that the
that's
economy needs for
political?
rate cuts. And yes, that's
Or
a
is that
that's
even
positive.
bad for
Markets will
Kamala
view
Harris
that as a very
because they're
positive
saying,
thing.
oh, the
But
economy
remember,
is
what
slowing,
markets are we talking about
you
here?
know, it's
So
slowing
ultimately,
dramatically.
if the Fed
And it
goes
is,
50
right?
basis
If you
points, goes
look
very
at the
aggressive,
last quarter,
cuts 100, 150 basis points, does that mean that their
GDPP, which
terminal
is
rate, do they end at
of
4%? Do
private
they end at
product, gross
3.5%?
domestic
Because right
private
now the
product,
bond
it's
markets have been
actually
pricing for the Fed to
experienced a
cut 200,
negative
250
quarter.
basis points. If that
Not only
doesn't
that,
happen,
but
that represents a
every single
disappointment to that
time
asset class, and that could lead to a sell-off
the
maybe in 2025.
unemployment
Also,
rate has
if the
rose
Fed
50
doesn't
basis
cut this
points, half a
full amount
percent.
that's being
There's
priced
been
in
in a recession
today,
the past
does that
9 times
represent
it's
a
done that.
disappointment even to
So
the equity
we're in
markets
an
at some point in
interesting
time, because equities are counting on this 250 basis
sequence.
point rate cut
every time
as well.
you know,
So
the
what's
yield curve
ultimately going to
inverts.
matter in this thing is
There's
going
been
to
a
be the data.
recession.
It's going to be the employment situation,
So
and
is
ultimately
this time
we're going to
different?
see
You know,
how
the number
inflation
one
creeps into
phrase
this
that
as well. So
will
look, we're at a good
kind of
starting point
hurt
right
you
now. The Fed has done
in
something very
investing.
aggressive. This is friendly to risky assets. There's no question about that. But
I
ultimately,
tend
the
to think it
question
is,
we need
but
to ask ourselves is, where does this end? And that's good.
yeah, the
That
market very
termination
well could
value is
close
going
red,
to determine the
right?
value of asset prices in the
But I'll
medium
tell
term.
you what, the
Yeah,
dollar
no,
is
and we have to go, but
definitely
I just wanted to
closing
kind of go
red.
back to that
Look at
dollar
the
chart, which is showing
USD
softness.
JPY
And
again.
again, you
It's
know, on the
actually
margin, you're
bouncing
talking
from
about
the
possibly
initial
reigniting
move.
certain commodity prices and
Hey, Kelly.
import inflation. Steve, last word?
Kelly, just give you a quick pricing here. We're at a 62% probability of another 25 in November, but a 93% probability of a 50 in December, which seems to be roughly in line. Maybe it's a quarter heavy,
So the
given what your
market's saying
last guest was saying.
75
The
more
market and
bips
the Fed
for the
now
rest of the year.
don't seem
So that's
crazily
120.
at odds
Jeffrey
over the
Gilmore,
outlook. Maybe a little bit more aggressive next year. But right
he's
now, they're within
pretty good at
25
this.
basis points. They'll resolve that. But right now, 25 built in for November, 50 built in for
Ultimately,
December.
do you need to predict
And
the
the Dow has now
Fed
gone
as
negative.
an
So it
investor?
spiked to record highs and has now
You
given
know, it
those up
helps,
as it maybe it's
but
changed
really
its mind
just
now, believing
knowing
more
how
in the
to
hard
react
landing
to it.
story.
So
Well, thanks to our panel. We
what does
appreciate
this
you
mean
joining us today,
for
David
tech
Kelly,
valuations,
Claudia
growth
Sahm,
company?
and
What
Jim
does this
Karen.
mean
Let's get to Mike
for
Santoli
a
now. He's over
rotation?
at the New
Are
York
we going to
Stock
rotate
Exchange.
into
Mike, what do you
financials
make
now?
of this stock market
Or
reaction?
is it
Well, in
cyclical
some sense,
season,
Kelly, it
right?
is the
So I want to
typical,
look at how rail
first
doing,
twitch
which
is
is
maybe
really
the
my only
wrong move, and then there's going to be a
cyclical,
backlash, and then there's going to be a rethink of the
pure
backlash,
cyclical,
all in the next couple of hours. So that's not unusual. I do think
industrial
the instinct to suggest
cyclical.
that there was more relief than not in the 50 basis point decision makes some sense. 25 basis points, while it would have been fine given unemployment where it is and given the
Yeah, it's
recent
actually
run of
down
data,
today.
has been pretty
So
reassuring.
at
I
least
still think
the
it would have
one
made the
cyclical I
market
really
just that
look
much
at
more
is
sensitive
not
to any
doing well
softness in
off this
data over the
range.
next 7 weeks until the next Fed meeting, and maybe left the impression the Fed was willing to fall behind, even if it's not behind just yet. All that mixed
So yeah,
together,
guys,
I
I'm
think,
I'm
has to
I'm
be
live on
put
YouTube.
against the
It's
fact that
probably
the
easier
S&P
to chat over
500 was
there, and you
already
can see my
near a
screen.
record
You can
high,
listen
already
to
at 21
CNBC.
times forward earnings, already pretty much
That's
juiced
end name
up
is
on
17.
soft landing expectations. I don't mean that it's
Ideally, I want
overdone,
to get
but it's
to
absolutely based on the
1,000
premise that
subscribers
we
on there, so I
probably are
can
going to
get
keep
some
an expansionary
video growth.
economy and rates
I
are going
mean,
to be tilting lower at some angle. So
live,
all that mixed together,
natural
I get the
leash,
response. Longer
organic
term
growth.
yields up a little more. So therefore, a little more
And once I
steepening
get to
of the
1,000,
yield
like I'm
curve.
going to start
Really not an
making
aggressive response
YouTube
in what you would
videos that are a
consider
little
to
bit
be the
higher quality
playbook for
than
the
what I
Fed
do
cut,
in
meaning small
TikTok.
caps and regional banks
I
and
mean,
things like
usually
that.
my
They
TikTok
kind of
videos are
rallied into it a
pretty
little bit
thought out.
more
It's
on
stuff
a
I've been
week-to-date
thinking about
basis.
for
So
a
maybe we'll
while,
see if that's to come
but
as we,
takes me
as we
15
get
minutes to make
through
those
the day.
videos.
All right, Mike, thanks very much. Let's now
These
go
YouTube
to
videos, I put more
Chicago and
effort
Rick
in per
Santelli
content,
for the
so
reaction in the
you're
bond
going to get
market. Hey, Rick.
more effort out of
And
me for the
I'm going to
minute,
have to start out with
2
the
minutes,
dollar
10
index,
minutes
Tyler.
you
I'm
spend
sorry.
on
Dollar index
YouTube
has some
and on TikTok.
significant technical
But
issues
TikTok's
it's going
nice
to deal
because I
with.
can
Now,
just
you're all
get it
talking
out
about it.
and we can
And
have a
granted, the
discussion.
low is around 100.39. But the key here is any kind of a close under 100.5 is going to be a technical violation, where we're almost guaranteed to test if we can hold up at 100. And it certainly looks like it's a possibility. 50 basis point cut, of course, is igniting issues with relationships to the dollar index, not only with the yen, but with the euro.
Yeah,
now,
the
if we
dollar
switch
index
gears
is now
and we go
reversing
to the
again.
two-year, the two-year was at
almost at the lows.
353. 353 before the announcement. It's at
So let's see,
357 right now. It's
what
been
happens.
as low as
This is
retesting.
pretty
That was
critical.
pretty
That's
much the
what,
low right around
that's
353.
not
And if we look
Santoli.
at 10,
Who's this guy,
they're around
Luciano?
359. They're higher, of course. They're at
The bond guy
365.
on
Now,
CNBC.
forgetting the numbers a
He's
bit,
always
if you
so
look at interest
dramatic about
rates, a
everything.
couple of things should jump out at you. Right now, about half the curve is above where it was yesterday on the close, meaning 7-year, 10-year, 20-year, 30 years or higher, but it's starting to creep down the curve. The equities have given up some of the ground, and the interest rate complex first initial
Drama
reaction
definitely does
was
sell.
a rally pushing
A lot of
yields
these
down. Then they
short-term
bounced
charts
back. Now they're coming
are too
back down. It's going to
reactionary.
be a big
Yeah, I mean, I'm just
two-way
looking at the
trade,
tick charts
probably till
because
Q&A. But what you really want to pay attention to
want
is
to
the
see
yield curve.
the
Right now, it's
granularity
steepened
of
about
what's happening
5 basis points, meaning
in these
long-term Treasury rates are a little
important
more
macro.
stubborn in terms of coming to the game and rallying, pushing
But,
yields down.
yeah, I mean,
and
I'm not
ultimately,
I'm not
if you
day
listen to
trading,
our
right?
panel, pretty much every guest we had on today, you know the good side of what the Fed did. But the other side you're going to hear a whole lot more about in the next 15 hours. A, 50 basis point cut this close to an election. B, 4.2%. There used to be a time when that was considered full employment. And when you look at some of the averages on job growth, they're still on most metrics above 100,000.
So the reason
with
why my
equities making
portfolio
new
is up,
highs,
can anyone
this is
guess?
a unique Fed situation.
Anyone?
And some Fed watchers
Anyone?
are going to be scratching their head.
Bueller?
Back to you.
The yield curve has de-inverted. Am I correct?
Actually, it's not so much Bitcoin. Why is Bitcoin not up more?
Right now you're at 9.6.
Let's see.
Your
For the
lower
day, my
yields on the
biggest
2s, your higher yields
movers
on the 10s.
is Coherent. COHR is at
Santelli, thanks very much.
82. Let's go, baby.
And markets are reacting across the board to the Fed's kind of surprise decision. Look, going into 2 p.m., it was almost a 50-50 call. We had really receded the possibility that this could happen. The Fed delivered 50. There was only one dissent. Stocks initially went to record highs. Then
Coherent's
the
a
Dow pulled
5%
back,
position
by
for me.
400
So
points, in fact, within minutes, and now it's climbing again. We'll get more on the market reaction
good.
as we build up to the
I
chair's
like that.
press conference at 2:30 Eastern Time. We'll
Yeah, I
take
mean,
care,
I
of
think
course, as soon as
Coherent's
it
like a
begins.
$95 stock by the end of the year, no doubt. But really, if you're looking at, you can see 140, 150. This is a compounder. It's something you're going to buy and hold throughout this AI cycle, throughout the next AI cycle. It's really crucial. It's one of those auxiliary, if you're broadening your view from NVIDIA, I think it outperforms even NVIDIA over the next 2 years.
So happy, warms my heart.
And I think NVIDIA is a $200 stock. I've talked about that a lot.
And make a difference together in someone's life.
Super high conviction on Coherent. I'm going to pull up the Coherent
I need to
chart.
tell you why Prop 33 has veterans like me so upset. So many of my fellow vets are struggling to afford housing in California. 33 makes things even worse. Prop 33 will stop new housing from being built, make it harder to find a place to live, and
yeah, I didn't really notice it, but Coherent's rip started well before
it's
the
why
Fed
veterans
news.
groups
So let's see if
across
there's any
California say no on Prop
stock
33.
With ServiceNow, AI can transform your business by helping your people work better. Because when your people work better, everything works better. So, let's get to work.
So you guys, come over to YouTube if you
How can optimizing
like to
our
see
operations
more.
through AI and machine learning technology help us continue to meet growing global demand?
How can utilizing cutting-edge technologies like the
So
metaverse help me get
they
the resources
announced,
I need to run
this
my
is
business
9/17,
efficiently?
this is
By
yesterday.
continually asking how, we're optimizing our drilling, exploration, and
Hitting
reservoir
its
mapping
52-week
operations to
high
streamline processes.
because of pluggable transceivers. So I'll talk into my thesis on why transceivers are really important for fiber optics. Through the glass, you're traveling at 200,000 meters per second. And you guys probably know 300,000 meters per second is the speed of light. So you're going 2/3 the speed of light in a vacuum. So the limiting factor is not really how long the fiber optics or the glass. I'm sure we could improve that, theoretically, from 66% the speed of light to maybe 75% the speed of light, but we're not operating in a vacuum.
A revolutionary laundry detergent that
I don't
magically
see it
dissolves in
in
any
the next
wash.
20
There's
years
no
some
wasteful
sort of
plastic
massive
jug, and it's
substrate
water-free because you already
gains in
have
fiber.
water.
So
The
the
laundry
limiting
detergent
factor really
has
is the
arrived. Learn more at
transceivers, right? So if you need
earthbreeze.com.
data, low latency for high frequency trading, or for AI, you need strong transceivers. So Coherent's at the forefront of that. They make lasers that go into ASML machines. So really all this lithography. They are the components that go into the machines that help us do 2 nanometer chips, which is super impressive. Has anyone seen a 2 nanometer chip, like zoomed in under a microscope? It just keeps on going. It's one of those like fractal things. Like
Welcome back.
these are now, at least with NVIDIA, getting designed by AI.
By half a point. The Dow had been up
even Apple,
all-time highs, in fact. Briefly
I saw an
traded,
Apple chip under a microscope,
S&P's
and
up 0.5%, Nasdaq the highest up.
you just kept on
0.8
zooming in.
so.
There kept
For
on
more
being
what
smaller and
investors
smaller
need to know, Mark
transistors,
Avalone
and
is here. He's president
it's getting
at Potomac
insane.
Wealth Advisors.
At a certain
What are you
point,
advising, Mark? Welcome.
Jensen
welcome.
Wong
And
says
that
we're
was a
basically
big
there. It's like
surprise for me.
we
And
don't
I
have
think
the
investors
substrate's
should
not allowing
make
us
any
to
knee-jerk
use
responses,
Moore's law
but I think
anymore.
there's
So
going
it's
to be
really
some
about the
opportunity
software,
here. We've
the
talked
design,
about the relative valuation differential between small,
to get
mid,
more
and
power.
large cap,
But
mega cap.
that's
I
not
think
all
a lower
about
rate environment
smaller
is going to
and
serve
smaller
small and mid cap
transistors
well.
on
So that
less
allocation
and less
still
space.
not too late to get there. Again, it's literally about 50% on a forward PE of what the large cap, mega
I
cap
certainly
is.
don't
So we
think
find that attractive.
that
we also think investors, whether this is a slowdown, 50
we're
basis
going to
point
stop.
cut, or a preemptive,
I mean, if
we
you look
wanna
at the
get out in front
Blackwell
50
versus
basis
the
point cut, we
H100
think
versus the
technology is the way
A100,
to
like
go. I know I've
it's
been a
like
broken record,
this
but
exponential
technology,
growth in
tech-enabled,
not only computing power,
old tech, new tech,
but
the
also
only tech we don't want
power
is
consumption.
non-cash
So,
flowing spec tech. That
bits
is not
are,
what we want. Otherwise, we are all in on technology.
Let's talk a little bit about interest rate sensitive sectors,
like,
and I'm thinking
I forget how they actually
mid-sized
measure
banks,
it,
most especially,
right?
Large banks.
It's
what happens
per
there?
kilowatt.
Well, this may be a
it's not all about bits per
I actually
kilowatt.
was at Bank of America down the street for a number of years, and my take on banks
or
is
no, it is about bits per kilowatt. It's not only about like
the repricing of loans.
how many flops you have.
Is going to hurt
if you
their
have
top line
40 petaflops,
and that cost
or
of
next
income.
generation it might be 80
because
petaflops.
they can charge
And
less.
I don't even know what a peta is. If anyone can tell me how much a peta is,
we'd have to have
it might be a trillion.
The deposit rate is going to be sticky. It's not 30 years ago when the banks controlled all of the deposits, and they would lower rates on the deposit side and keep loans higher.
So it's not all about computing power. It's also about
so much competition
efficiency
for
power, because power might be the
So you think they were sticky when they were low. Banks didn't want to raise deposit rates. Now you think they're going to be sticky at
so nuclear is important. I think we've talked about that a lot in life. Let's get some nuclear power.
These specialty lenders. I was out looking in the green room at current money market rates. There's some places that are offering over 5% still. So they're not going to be dropping 50 basis points when that loan revenue drives for traditional lenders. Now, this is the opportunity, is to go to a diversified financial, one that has capital markets, trading, asset management.
Oh, one thing I bought today was APA Corp.
I have a little hesitation.
So it's been a name I've liked for a while, but just because I didn't like gold, oil, I wasn't in it.
Making the call, and
now,
we've been riding that.
And I bought it at low 20, like 25, 12, I think.
Yield curve. I'd like to see if this is a 50
now,
basis point
I'm thinking like having some energy exposure is good.
steady,
Also, I'm moving over from Schwab
Mark, thank you very much.
to
Appreciate it. Thank you. And we are just moments away now from Jerome Powell's
interactive
press
brokers,
conference, and we will
because
get more
Schwab's margin rate is 13%. So I've been like, geez, like it's going to be hard for me, even in the short term, justify paying 13% per year or 12% per year, whatever it is. Instead, I'm going to interactive brokers, which is at 6%. So it's cutting my margin cost in half. And, I don't consider it too much risk, too much more risk to, be like, okay, now that I'm paying 6% per year, I can buy some Apache. I can buy some JP Morgan. I can diversify more. Sure, that's going to put me on margin. I'm going to have to pay 6% per year. But do I think Apache is going to be up more than 6% over the next 12 months? do I think JP Morgan's going to be up 6% over the next 12 months? Certainly. So I'm able to use leverage to actually, increase returns, and in terms of total risk, it's not really going up that much because I'm diversifying
Sometimes
marginally
it can feel like
away
there's
from
no
tech.
way out of treatment-resistant depression. You take
So
one
do I
antidepressant
suggest
after another,
you
and
use
they aren't
margin?
working for you. It's like you're going
Not
in
unless you
circles.
really know what you're doing.
Turn to a different choice. Spravato is the first FDA
Do you own
approved
HEPs,
nasal spray
Luciano?
taken with an
Because
oral
at 230,
antidepressant for adults with
220,
treatment-resistant
I mean,
depression.
under $3, I think it's a
Spravato
home
can
run.
cause sleepiness, feeling disconnected from yourself, your thoughts,
Yeah, Warren
space
Buffett
and
wouldn't
time,
suggest
dizziness,
using margin
fainting,
either,
spinning
but
sensation, anxiety, and breathing
like,
problems. It's taken under the supervision of a healthcare provider who will
I think
monitor
I got
you
strong
for at
risk
least 2
management.
hours after taking Spravato. Don't drive, operate machinery, or perform activities that
If
require
I-
full alertness until the next day after a
if
restful
I
sleep. Spravato
go
doesn't prevent suicide,
and buy,
reduce suicidal
5%
thoughts or
position
actions,
in
or
Apache,
replace
5%
hospitalization if needed.
position in
Call your doctor right away about
JP
unusual changes in
Morgan,
behavior, worsening
it's actually
depression,
taken
or thoughts
the
of suicide.
size of all my other
Antidepressants may increase
positions down.
suicidal thoughts and actions
Not in
people
terms of
24 and
how
younger.
much I own,
Spravato
but
is not
in
for
terms
use
of
in
percentage
children.
of my
There's a
portfolio.
risk for
So
abuse and misuse.
you could argue
Don't
that
take
it's
if you have
actually
a blood vessel
de-risking
disease,
by
an abnormal
using
connection between
margin
your veins and
from
arteries,
this
a
perspective.
history of
Obviously,
bleeding in the
de-risking
brain,
from that
are
would be like
pregnant, or may become
selling all
pregnant.
that tech
Spravato
and
is not
going
for use as a
into
medicine to prevent or relieve pain. Spravato may cause serious side effects,
more
such as increased
diversification,
blood
but
pressure, problems
I'm
thinking
not
clearly, or
interested in
bladder
selling
problems.
right now.
With fewer depression symptoms, you may
Sorry
begin
guys, I
to
can't
feel like
take
yourself
any
again.
guests on TikTok right now.
Ask your doctor about Spravato.
If you want to head over to my YouTube, you'll be able to ask questions better there. I wish I did a poll. Let's see if I can do a poll.
Bond King Jeffrey Gunlock. First reaction to the Fed decision. Impact on the market. Economic outlook. Crucial insight for investors. Closing bell. Today, 3 Eastern. CNBC.
Okay, poll. Quick poll.
All right, welcome back to Power Lunch. We're just moments away now from Fed Chair Powell's press conference. And before we do that, let's bring back Claudia Sahm, New Century Advisors Chief Economist. Claudia, it would seem as the chair has some adroit needle threading to do here. What do you expect him to say?
All right, I only got 5 of you in here.
To give a very clear message on the decision they made today to really explain
Glenn,
what it is
I didn't
and
say
the
it was
criteria that
definitely
they're
not
going to
going to
use
be
as they
50.
go forward.
So
Powell's
calm your
strong
horses.
suit is his communication and an ability to
I bet my
just
portfolio is doing
say it.
better than yours today.
And I think that's what they will lay out today in the press conference, and that's what we absolutely need. So he needs to bring that.
You know, as you say that, I think back to his hawkish
Yeah,
press
so,
conferences that used to upset the market. You know, they would come out with something at 2, the reaction
vote
would be relatively ho-hum, and then he'd start
the
to
smiley
talk, and we'd
emoji
kind of
or
get
the
this big
cry
sell-off.
emoji.
Is it now?
Depending
So
on
I thought
this
going
makes
into
you
today it might
happy
be the opposite,
or
where maybe they go
not
25,
happy.
but then he's quite dovish as he has been, kind of going back to Jackson Hole and talking
Ready?
to the labor market. Now that they've gone 50, I don't know if I should expect dovish Powell or more moderated Powell to explain, no, the economy's not that
Right here.
bad. And
Do you
so I'm
guys
just trying to
like
think
the
through
50 bips or not like the 50
You know,
bips?
it is clear because of where the decision landed that the federal
Luciano,
market really had
buy
a lot
some
to talk about
HEPs.
in
Put
the
it on your
last
radar.
few days, last few weeks.
Not financial
and so
advice,
he's
but
going
do
to
it.
communicate the plan.
I really love the
And
company.
so I don't want to
Right.
hazard a
It's
guess as
trading
to
at.
exactly what
You
that
want to
is.
look at the financials?
Now, you know, the action is pretty dovish today, so going more dovish might, you know, push the markets even further. And I think if you look at the summary projections, you
I'll
don't
first show
have,
you in Turkish
Fed
lira
officials on their
because
own going
this kind of
much,
shows
much
you
more
like
dovish than where, say, the
constant
markets are right
currency,
now. I think
what's
a lot
going
of it is
on.
just explaining where we're at and where we're headed.
We're going to have
and
another
largely,
41% growth
there seems to be some
in
agreement
Turkish
between
lira
the Fed and the
in
market. So they
2024.
don't, you know, he doesn't need to do anything too
And
fancy.
if this thing is growing at 40% year over year in Turkish lira, and the lira is getting stronger, so you know maybe if it gets 10% stronger, that's
over the past 3 to 4 years,
or is that
related to
50%?
price
Not
gouging.
sure.
Literal price gouging.
The pandemic
So
kicked
EBITDA
off
in
a
terms
lot
of
of
lira,
disruptions, supply chains, also in the labor
6.2
force, labor
billion
shortages.
divided
And we are
by,
going to look back, and I think
look
the
how much
research
cash
more
that
and
is
more
in lira,
points to the
divided by
COVID
19.
disruptions.
You're talking about
are
a
the key source. Now, COVID created
3.25
a lot of
EBITDA.
circumstances,
It's trading at a 3x
but it did
EBITDA.
shift some of the pricing
Let's look
power.
at USD.
It did. There were opportunities, and also with the war in Ukraine. So it gets
Again,
into this very
it's
tricky.
3.
What's the cause? What's the problem?
So,
So
3 times EBITDA company currently
the pandemic was rude of you.
trading, growing at 40%.
Let's listen.
That's pretty
My
outrageous.
colleagues and I remain squarely focused
And
on
I think
achieving
this
our dual
17 cents a
mandate
share is
goals
super low.
of maximum
But even if it
employment
was
and stable
17
prices
cents
for
per
the benefit of
share,
the
that's
American
like
people.
15 PE.
Our economy is strong overall and has made significant
They're
progress
dominating.
toward our goals over the past 2
They're
years.
really doing well in Turkey,
The labor market
but
has
they're
cooled
executing
from its formerly overheated
on
state.
margins,
Inflation has
consistently. So that
eased
was
substantially from a peak of
0.7%
7%
net income.
to an
Then
estimated
it's going to be 2.4.
2.2%
I expect this to
as
be
of August.
3.
We're committed to
that's 3,
maintaining
that's
our economy's
25
strength by supporting
cents.
maximum employment and returning inflation
Even
to our
EBITDA,
2% goal.
1.9% EBITDA margin in
Today, the
2023,
Federal Open Market Committee decided
7.6
to
going up
reduce the
to
degree of policy restraint
8.9.
by lowering
So
our
9%
policy
EBITDA
interest
margin.
rate by a half percentage
This is
point.
trading,
This
enterprise
decision
value
reflects our growing confidence that with
2
an appropriate
and
recalibration of our policy stance,
or point
strength in the
basically
labor
like
market can be maintained in a
point
context of moderate growth
2.5
and inflation moving
no, it's not a
sustainably
quarter,
down to 2%.
0.3 maybe.
We also decided
sales
to continue to reduce our securities holdings.
is trading at
I will have more to say
0.25
about monetary policy after
sales in
briefly reviewing
2025.
economic developments.
And this is just, we're 3 months away from
Recent
ending
indicators suggest
2024.
that economic
So this
activity
is
has
really
continued to
what
expand
the
at a
forward
solid pace.
PE looks like. It's
GDP rose at an
about
annual
15.
rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer
Jake, I was
spending has
speaking. You
remained
can hear it on
resilient,
my
and
YouTube.
investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than
Sounds
projected.
pretty confident about inflation. I'm trying to figure out.
Inflation has eased notably over the past 2 years, but remains above our longer-run goal
Trying to figure out
of
what
2%.
he's saying about the labor market.
Estimates based on the
He said it
Consumer
was
Price
up,
Index and other
but
data
it's not,
indicate that total
it's
PCE
just still
prices
historically
rose
low levels.
2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys
yeah,
of
if you're talking about
households,
HEPS,
businesses,
Luciano,
and
absolutely.
forecasters,
I mean,
as well
you
as
want
measures
to
from
buy
financial
this thing
markets.
in between earnings reports.
The
If you go
median
back,
projection in the SEP
it's like a
for
month
total
after
PCE inflation
earnings
is
that it usually
2.3%
bottoms,
this year and 2.1% next
or a
year,
month before earnings.
somewhat lower
It's
than projected
like
in
that
June.
period that
Thereafter,
it does
the
poorly
median
because
projection is 2%.
this is not a highly followed stock.
Our
Only around
monetary
earnings
policy
reports
actions
get
are
a little
guided
bit
by our
more
dual mandate to
attention
promote
because
maximum
analyst reports
employment
come out,
and
and
stable
every
prices
single
for the
time
American people.
the analysts are like, "Ooh, they're
For much of the
executing
past
well.
3
They did
years,
exactly what they
inflation
said they were
ran
going to
well
do.
above
In
our
fact,
2%
beat
goal,
guidance within the
and
past
labor
3-4
market conditions were
quarters
extremely tight.
like that."
Our
So
primary
gold is at
focus has
2,600.
been on
Everyone,
bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored.
just nibble, put your toes in, buy, make a 1% position
Inflation
in
is now
HEPS.
much closer to our objective,
Because this is, this is a $5-6 stock
toward
next
2%.
12, 18 months.
As inflation has
And
declined and the
I
labor
think it's
market
a
has cooled,
$10 to
the upside
$15
risks to
stock
inflation
in,
have diminished,
3
and the
to 5
downside
years.
risks to employment
That's at
have
least,
increased.
25%.
We now see the risks to achieving our employment and
maybe
inflation
30,
goals
35%
as roughly in balance. And we are attentive to
return
the
on
risks to
invested
both
capital
sides of our
annually.
dual
So
mandate.
that's
In light
really
of the
good.
progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate
I mean,
by
it's
a half
literally
percentage
my
point
highest conviction.
to 4.75%
besides
to
Bitcoin.
5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation.
So compare
as we
HEPS
begin the process
to
of moving
Melly.
toward
Okay.
a more neutral stance.
So HEPS
We are
growing
not
40%,
on any preset course. We will
6
continue to
times
make our
2025
decisions
EBITDA.
meeting by meeting.
Melly.
We know that
And again,
reducing
Melly
policy
has
restraint
Mexico
too quickly
and
could
Brazil.
hinder progress on
Each one
inflation.
of those markets, it's kind of similar
At the
to
same
Turkey.
time, reducing
It's,
restraint too slowly could
not a
unduly
huge
weaken
difference.
economic
So Melly
activity and
maybe has
employment.
twice as many markets.
In considering additional adjustments
Twice as
to
big
the
of a
target
market,
range
you
for
could
the
say
federal
that, even
funds
though
rate, the committee will carefully
HEPS
assess
has
incoming
expansion
data,
opportunities
the
in
evolving
Eastern Europe.
outlook, and the balance of risks.
But it's only growing
In
24%,
our
40%
FOMC
this year.
participants wrote down their
It's
individual
trading at
assessments of an appropriate path for the federal
25
funds rate
times EBITDA
based on
of
what each
2025.
participant judges to be
So
the
would
most
you
likely
like
scenario
3
going forward.
or would you
If
like
the economy evolves as
25?
expected, the median participant projects that the
23,
appropriate level of the federal funds
So
rate will be
if you're saying that
4.4% at the end
Melly's
of
worth
this year
a
and 3.4%
multiple
at the end of 2025. These median projections are lower than in June, consistent with the
times
projections
more
for lower inflation and
than
higher unemployment,
HEPS, I would
as
say
well
you're
as the
crazy.
changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated,
JPow's
we are prepared
just,
to respond.
giving himself options right
Policy
now.
is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has
You
been
think he's
assigned two
well-positioned?
goals for monetary policy: maximum employment and stable prices.
He
We remain
doesn't,
committed to supporting
I'm not
maximum
seeing him
employment,
speak right now.
bringing inflation
His
back
words
down
sound
to our 2%
confident.
goal, and keeping
His voice
longer-term
doesn't
inflation
to me.
expectations
Thanks,
well
Jake.
anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
And now it's question time. So
Steve
yeah,
Leaksman,
I mean,
CNBC. Thank you, Mr. Chairman, for taking our questions.
for
In
2x
July,
bigger
you said
market,
you weren't necessarily thinking about it. 50, you didn't want to be
growing,
specific. You said you weren't thinking about it.
60% as much
The
in
inflation data last week
2025.
came out a little firmer than expected.
Is
Retail
Melly
was
really worth
strong third quarter GDP running 3%. So what
8
changed that
times
made
more?
the committee go
I
50?
don't
And how
think
do you
so.
respond to the
I think
concerns that perhaps
HEPS
it
will
shows
never
the Fed
get
is
the
more concerned
multiples of
about
Melly,
the labor market?
but
And I guess should we
I don't.
expect
I
more
think Melly's
50s in the months
overvalued.
ahead? And based on what should
But
we
it
make
should
that
be,
call? Thank you.
max 2x
So,
multiples,
okay, a lot of questions
not
in there.
8x. So that gives a
Let me jump in.
400% upside.
Since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we
He's acknowledging that his payroll data might be artificially high.
that this was the right thing
That's interesting.
for the economy, for the people that we serve, and that's how we
sentiment,
made our decision.
pretty bullish.
So that's one question.
Maybe not until
What was the
mid-October.
second and third?
Am I going to get uber bullish?
Sorry, thank you, sir.
I'm feeling pretty
How
good.
do we figure out?
I think it's a much higher likelihood
we
we see
6,000
6,000 than 5,300.
Based on what shall we make that call? Thank you.
And we're at 5,650 right now.
A couple things. A good place to start is the SEP, but let me start with what I said, which was
So
that we're
again,
gonna be
not
making
financial
decisions
advice, but
meeting by meeting, based
always
on
have the ability
incoming
to buy
data, the
more,
evolving outlook,
right?
the balance of risks.
Be making money. You can
If
put
you
a
look at the
paycheck
S&P,
in there.
you'll
You
see
can live,
that it's
maybe
a process
not go out,
of
not go to restaurants during that
recalibrating
month.
our policy stance away from where we had it a year
But
ago
be
when
basically
inflation was
fully
high and
invested
unemployment
is
low,
what I would say.
to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing
Playing
in
classic
the
Spyro
SEP that suggests the
with the
committee
policy.
is in a
What is
rush
Spyro?
to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that
I was always
the actual
honest.
things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber at Associated Press. Thank you.
I think these dot plots are pretty
The projections
stupid.
show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher?
So the question is...
I think the way I would really characterize it is this. I think people write down their estimate, individuals do.
Listen.
I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know
He's
it by its
basically
works.
saying there's a wide range of
So that leaves us in a
outcomes.
place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level.
Zero Hedge says
So
red
the balance of risks
close
are
and
now
it
even.
gets
And
ugly.
this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral.
The other thing that I
and
like
we'll
about Interactive
move as
Brokers
fast or as
is
slow as we think is appropriate in real time. But
they're
what you
giving me
have is
naked
our individual
options,
accumulation of
and,
individual
I'm
estimates of what that will be in the
look
base
at
case.
futures. I signed up for like every future, and then Europe wants my passport, so I hope that doesn't.
Howard
Because
Schneider
I
with
don't have my
Reuters.
passport.
How
I hope that
close
doesn't
was this
block
in
me
terms
from
of
what I really
decision? You
want,
do
which
have
is
first
just
dissent
crypto
by a
futures
governor since
and crypto
2005,
future
I think.
options.
Was the
which would be
weight
sweet.
clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth.
So
good negotiated division. Excellent
the
discussion
futures
today. I think there was
that
also
I
broad
would do
support for the
on
decision
crypto would
that
be
the committee voted
a
on. So
January
I would add, though, look at the
option.
SEP. All 19
I don't know how much it would
of the
cost, but
participants wrote down
maybe
multiple
85K
cuts this
Bitcoin.
year. All 19. That's a big change from June.
I'd love to see. Does that cost
$7 of the
$1,000?
7 of them
Is there
wrote down
many
3 or more.
future?
And, 17 of the 19
Because if
wrote
it goes
down
to
3 or more
100,
cuts, and
that's
10 of the
would be
19
50
wrote down
next.
4 or more cuts. So, there is a dissent,
with
and
a
there's
Trump,
a range of views, but there's actually
maybe
a
it
lot
would be
of
in
common ground as
February
well.
because I think day one executive orders. Gensler is going to be out. These are an executive order. But Gensler and Khan are going to be out. But also possibly an executive order. We can no longer sell Bitcoin. And then the narrative would be like, well, are we going to buy Bitcoin? We're going to make a Bitcoin reserve for the U.S. government? Because that would be insane for
feels it's in a
we're
rush to
talking
do this.
300K.
We made a good, strong start to this, and
Like
that's
within
really,
12 months.
frankly, a sign of our confidence. Confidence that inflation is is coming down.
I mean, the majority of my crypto right now is in ARC-B. Now that I'm moving over to Interactive Brokers and I can buy straight Bitcoin, I might do that.
And I'm very pleased that we did. To me, the logic of
But
this,
the
both from an
spread
economic
you pay
standpoint and
for
also from a risk management
Bitcoin,
standpoint was clear. But I think we're going to go
might be higher
carefully
than the
meeting by
management fee
meeting
over a couple of years for
and make our decisions as we
ARC-B.
go.
So if you're going to trade in and out, probably just trade Bitcoin ETFs.
Hi, Chair Powell. Gina Smilek, the New York Times.
I'm so long-term that I'm thinking
You and your colleagues in your economic
just buy
projections
Bitcoin at this
today
point.
see the unemployment rate climbing
But again,
to
it's already
4.4% and staying there.
16%
Obviously,
position
historically,
for
when the
me.
unemployment rate climbs that much
My
over a
max
relatively short
position is going
period
to
of
be
time,
around
it doesn't
30.
typically just stop.
If I get a
increasing.
Bitcoin's
and so I wonder if
future
you can walk us through why you see
for
the labor
February and it
market
goes to
stabilizing,
115, I'm going to be over 30%.
and what do you
I
see as
might
the
not
risks?
trim in the short term. I might wait until the end of the quarter or
Again,
until
the labor
that future
market
comes
is
off.
actually in solid condition.
Until I sell that future.
And our intention with
So
our
I'm not
policy
going to be
move today
hard
is
capped
to
at
keep it there.
30.
You can say that about the whole
But,
economy. The U.S.
you
economy
know, I might
is in
also
good
buy
shape.
some puts
It's growing at a
on
solid
ARC-B
pace.
just to offset
Inflation
my
is
Bitcoin
coming
position.
down. The labor market is in a strong
Because
pace.
I want to keep the upside.
We want to keep it there. That's what we're doing.
Depending on how expensive they are.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. But so I would say we don't think we're behind. We do not think we're behind. We think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. So your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about
Al says he's not behind.
The high nominal level of funds
and this is a commitment to not be behind.
What might be expected
Pretty strong
if you're
statement.
trying to maintain equilibrium?
So I think it's about
Kamala Wynn.
We come into this with
I'm just
a
going
policy
to keep
position
it.
that was put in
Now,
place.
do I
as
think
you
it's going to
know,
do as
I
well under
mentioned
Kamala? No.
in July of 2023.
That future,
inflation
I would
and very
probably
low
sell
unemployment.
if I bought it.
We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it.
He says this is a strong move, but do not think this is going to be the new
So
pace.
in the base case, what you see is look at the S&P. You see cuts moving along. The sense of this is we're recalibrating policy.
I'm just listening.
Down
If you want to come over to
time
YouTube, you can listen with me.
A more neutral
and see
level.
SPX on a tick
we're
chart.
moving at the pace that we think is
Also,
appropriate
now
given
I'm gonna
developments
check
in the
the
economy
dollar
in the base case.
Index. Dollar's
The
back
economy can
above
develop in a way that would cause us to go
100,
faster or slower.
and
But
50
that's what the
cents.
base case says.
JPY.
2019, when you did the mid-cycle adjustment, you
Rallying
ceased
too.
the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation,
about the
reserves
balance
have
sheet.
really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the
So the question is,
overnight RRP.
thoughts
So
on
I
a
think
50
what that
basis
tells you
point
is
cut?
we're
It
not
surprised
thinking
me
about
because I
stopping
feel like
runoff because of this.
Powell's
we know
wary to
that
be aggressive.
These two things can happen side by side. In a sense, they're both
He
a form
likes
of
to take it slow,
normalization.
but
And so
I
for a
think
time,
really
you
what
can have the
happened
balance sheet
is
shrink
they
but
realized
also
they
be
probably
cut
should have
down.
cut 25 last meeting. So they're doing 50 now.
Thank you, Colby Smith with the Financial Times.
The
Just following up on
statement, which
Gina's
is
question on
possibly
rising
more important, I
unemployment,
think is pretty strong.
is it your view that this is just a function of a normalizing labor market amid improved supply?
He knows how the market
or is there
reads
anything to
this.
suggest that
Again,
something more
it's positive.
concerning
If it
perhaps is
closes
taking place here, given that other
negative,
metrics
I
of labor
think that
demand
would
have
be not
softened
so
too?
good. I don't think this is
And I
uber
guess
bullish in the short term.
in direct follow-up to Gina is, why should we not expect a further
Maybe
deterioration
for
in
small
labor market
caps.
conditions
for internationals that like weak dollars.
I think what we're seeing
because
is
again, energy prices are down, oil prices are down, even though they're up over the past week. Now rates are coming down.
As I talked about in Jackson.
Both of those should stimulate the economy.
But they're still at a
so,
level.
corporate profits should go up.
Is actually pretty close to what I would call maximum
should go
employment.
up and then lead to corporate
so
profits.
You're close to mandate. Maybe
even revenue
mandate
should go up
on that.
So like,
driving
I don't
it?
see how you can be super bearish.
Clearly, payroll.
Sure,
job
there's all the
creation has
data.
moved down over the
Past
last few
9
months,
times
and
unemployment rate has gone up,
and
50
by
basis
many
points,
other
0.5%.
measures, the labor market
There's been a
has
recession.
returned to or below
When the yield curve
2019
inverts,
levels, which
there
was
is a
very
recession.
good,
People say
strong
they don't
labor
say
market,
when
but
though.
this
It
is
could
more
be
sort of
2018,
17.
60 months later
the
that
labor
there's a
market bears
recession.
close,
So that's not
bears
really
close
indicative.
watching, and we'll be giving it that.
So it takes some weeding through,
But ultimately, we think,
again, I
we
don't
believe
really.
with
I don't really buy into the bearish
recalibration of our
narrative
policy
right here.
that we can continue to see the
And you get all
economy
these
growing,
things
and
like
that will support the
geopolitically
labor
that could
market.
get
In the
resolved.
meantime, if you
Russia,
look
Ukraine,
at the gross
Israel.
economic activity
So like,
data,
could they
retail
get
sales
worse?
data that we
Yeah,
just got,
sure. We could be in a full-out
second
war
quarter
with
GDP,
Iran. It could be
all of
World
this
War
indicates
III.
an
That's
economy
really
that is still growing
the
at a solid pace.
actual
So that
black
should
swan
also
that could
support
happen.
the labor market over time.
But black
So,
swans
but
are not
again,
usually predictable.
It bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. We're not hearing that from companies.
I'm over on
that's
YouTube if you want to see my
ready to
screen.
happen. So we're not waiting for that because there is thinking that the time to support the labor market is when it's strong and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the
marginally, if you guys like my content, the best thing you can do to help, I mean, Substack for sure, but subscribe to YouTube.
With Bloomberg TV and radio. To follow up on that,
I put most amount of effort into Substack right now per release.
In the labor market. You're pricing in basically
it could,
by the end
like
of
if I get to
next
1,000
year,
YouTube
200
subscribers, I could
just to maintain
put the
a
most
higher
amount of effort
unemployment rate.
into that.
Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%.
Let's see the order book.
At the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So That's one thing. Participation is at high levels. It's, we're adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. Quits
on the SPY doing the market
come back down
really
to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months.
A big drum.
So what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased, and because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
Yeah, JFIN's up a lot.
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and
doesn't the 50 basis point mean economy's in some trouble?
Evolving outlook and the balance of risks. And then
I think it has potential to create that narrative, but the data is the data. I don't think the Fed has data we don't have.
Over time. So that's what it is.
So the economy has been slowing. Do I think it's recession territory?
Chair Powell, Neil Irwin with Axios.
Oh, really?
We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level?
I really don't think they look at more data.
Trends of the last
I mean,
couple of years
sure,
has been,
they'll look at high frequency data,
job openings falling rather than
but
job losses.
really,
Do you think
because
that
they
trend
have
has
to
further to run, or do you
explain
see risk that further labor market
all their
cooling has to come through
decisions,
job
they're not going to
losses?
reference,
on the
credit
job
card
creation,
spending or stuff like that. So
on
marginally,
the
but I
inflows,
think less than 10%
right? So
of their
if
decisions
you're having millions of people come into the labor force,
high frequency data
and you're creating
that they were
100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into
Fed dot plots signaling faster cut pace, almost 200 points by the end of 2025. I mean, that gets us basically to neutral.
Tightness come out of the labor market in that form without it resulting in lower.
In fact, if inflation stays at 2.2%, 3% is going to be a real
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate.
Now the bid is 10, so you can buy them for the same price I got. The IV is 49.
So this is a question. You mean
so for
after
a small
we get
cap,
through all of this?
That's massively undervalued, like X.
Great question that we can only speculate about.
Really cheap
intuitively, most many people
I'm trying to
anyway
buy
would
these
say
too, but
we're
at
probably not going back to that era where there were
or I did
trillions of
buy one at
dollars
0.7.
of
I have another one at
sovereign
0.65.
bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But, it feels to me. And
He said, I don't think we're
that
going
the
back to
neutral
negative
rate
interest
is
rates,
probably significantly
but
higher
honestly,
than
we're
it
going to
was
find
back
out.
then. How high is
That
it?
is
I
about
just
as
don't think we
dovish
know.
as you could make that
Again, we only know
statement.
it by its works.
One more. How do you respond to the criticism that will likely
And the
come
market did
that a
not like
deeper
that.
rate cut now before the election has some political motivations?
Yeah, so this is my fourth
political
presidential
motivation
election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group.
Yeah, we're negative,
and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other
this
filters.
concentrates
I think if you
the
start
mind.
doing that,
We don't think about
I don't know where you
politics.
stop.
This is
So
my
we just
fourth
don't do that.
presidential election.
Thank you, Chair Powell. I'm Jolene Kent with CBS News.
So the idea
My
that
first question is,
that cuts are
very
bad for
simply,
tech,
what message are you trying to send
because
American
tech
consumers,
did
the
well
American
with
people,
high interest
with
rates.
this
Like, think about a
unusually large
DCF,
rate
right?
cut?
Your discount rate goes down,
I would
future
just
cash
say
flows
that,
are worth more.
the U.S.
So
economy
why would
is in a
tech
good place. And
do
and
poorly
our
with lower rates?
decision
Think
today
about
is
from
designed to keep it
2010 to
More
2019.
specifically, the economy is growing
Rates
at a
went
solid
down,
pace.
tech went
Inflation
up.
is coming down
So
closer to our 2%
I think maybe in the
objective over
short
time.
term, there's a
And the
rotation
labor market
because
is still in
financial
solid shape.
balance sheets do
So
better.
our
But also there's
intention
less
is
of a
really to
spread for these
maintain the
financials
strength that we currently see in the U.S.
to make
economy.
money. So like,
And we'll do that by returning rates
yeah, their balance sheets
from
get
their
better,
high level,
but
which has really been
their income
the
statement
purpose of
doesn't.
which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that.
What about if
Listening
we
to
go
you talk
into a
about
deep
inflation
recession?
moving
Yeah, I
meaningfully
mean, do you
down
think?
to 2%,
So are you talking
is the Federal
specifically
Reserve
about
effectively
tech?
declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation. The goal is to have inflation
And guys, come
move
over to my
down
YouTube if you
2%
can.
on a sustainable
I'd appreciate
basis.
a subscription.
We're not really, we're close, but we're
It's
not
just
really
a
at
couple
2%.
clicks for you
And I
guys,
think
and it
we're going to
really
want to
helps
see
me
it
out.
be,
But also you can,
around 2% and close
chat.
to 2% for
Look
some
at what I'm
time.
looking at.
But we're certainly not doing. We're not saying mission accomplished or anything like that. But I have to say though,
Thanks,
we're
Jigga.
encouraged by the progress that we have made.
Where are you from? Are you American? Yeah, you look American.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So, housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want.
Luciano's
them to,
American. He's going to be
moving at
voting in the next
relatively low
presidential
levels.
election.
But
He's
they're
going to
not
go to a
rolling
swing
over.
state
The
and
leases
fill
that
out
are
a mail-in
rolling
ballot.
over are not coming down as much, and OER is coming in high. So
have I ever been right about anything?
It's been slower than we expected. I think we now
Birdsy,
understand
birds,
that
birds,
it's going
birds.
to take some time for
You
those
show me
lower
your
market rents to get
P&L,
into this, but
and
the
I'll show you
direction
my
of travel
P&L,
is clear,
and we'll compare.
as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather
Now,
than just one or
Luciano's
two cycles
voting
of
100
annual lease
times.
renewals. So that's, I think we understand that
for
now.
Jill Stein.
I don't think the outcome is in doubt, again, as long as market rents remain under control.
Maybe you were right in
The outcome is not
Trudeau
in
on
doubt.
there.
So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. You know, they all have some volatility. We will get down to 2% inflation, I believe, and I believe
you're going to be the one person
we'll get
that gets arrested
what we
for
need to get
voter,
out of the housing services piece too.
Some of your colleagues have expressed concern
it's going to be election
with
interference.
starting to cut rates, you
Any
could
position in
reignite
ETH or
demand
Solana
in
right now?
housing and
No,
see
I mean, I like
prices go up
Solana,
even more.
I like ETH,
You know, what's
but
the
I think
likelihood of
it's
that?
Bitcoin season.
And how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on
You're
track
married,
to continue to have.
Your
not
wife
enough
doesn't
housing.
care about your
And
P&L,
so
I'm
it's
sure.
going to be challenging. It's hard to find to zone lots that are in places where people want to live.
Maybe your dog doesn't
It's
care about your
all of the
P&L.
aspects of housing are more and more difficult, and where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy
Let's see,
operates
was I right
with long and variable
when
lags.
I said
and I'm
we were going to
wondering
get
how
to
much you see being able
SPX
to
10,000
keep the
by
unemployment rate
2030
from
at 3,800?
raising too much
Maybe
comes
I'm
from
wrong.
the fact that you're starting to
Looks
act now,
pretty
and that's
good.
going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy.
Odds on
You
gold,
have an
I mean, I
economy
just
that
prefer
is
Bitcoin.
growing at a
Gold
solid
is at
pace.
2,600.
If you
Hit
look at
2,600
forecasters or
today.
talk to
So
companies,
it's doing well, but
they'll say that they think
it's an 18,
2025
19,
should
maybe
be a
even
good
$20
year too.
trillion market
So,
cap now.
There's no sense.
Bitcoin
The U.S.
is
economy
1.3.
is basically fine. If you talk to market
way more
participants,
upside
I mean, business people who are actually out there doing business. So I think, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment.
I mean,
to make sure that we don't fall behind.
Nobody.
So really asking about,
I've never
your
met
second question,
anyone
you're asking
that's
about
got
July.
rich
And
off
I guess
gold.
If you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not. That doesn't.
He's saying
really
if you
answer
got
the
the
question
data
that we
sooner,
ask
he
ourselves, which is
might
let's
have
look.
cut.
At this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy
Yeah,
stance?
but gold
we need to
only
move to?
returns over
It's
the
clear
long
that
run maybe 3%.
Literally, everyone on the committee agreed.
I'd say
that
get
it's
rich
time
and
to
buy
move.
stock.
It's just how fast do you go, and what do you think about the path forward? So,
Because you're
this
not going to
decision
have
we made
passive
today had broad support of
income
the committee, and
off
I've
of
discussed
gold.
the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop?
You bought a
over the
condo
next
before
year?
these rate cuts. Well, you could
Very hard for me to
refinance,
say.
right?
That's from our standpoint. I can't really speak.
You
to
buy
mortgage
the
rates. I
home,
will
rent
say,
the rate.
That'll
Do I think
depend
they'll end
on how the
QT
economy evolves.
soon?
That's
another question.
Intention, though, is we think
I
that
would
our
say
policy
no. I'm leaning no.
Was appropriately restrictive. We think that it's time to begin the process.
No, I think they're going to be playing with rates before they
recalibrating it. to a level that's more neutral rather than restrictive.
Go back
we
to QE,
expect that
although
process to take some time.
they probably should do
as
QE
you can
before
see
lowering
in the
rates,
projections
because
that we
then their
released
balance
today.
sheet would
And
benefit. They would
as
buy bonds
if things work
when
out
they're
according
cheap
to
and,
that forecast,
then
other rates in the economy will
lower
come down
rates
as well.
so that
However, the rate at which those things happen will really depend on how the
their
economy performs. We
bond
can't,
holdings
we
go
can't
up,
look
their
a year ahead and know
treasuries
what the
go up.
economy is going to be doing.
But I tend to think that
households who are
QE
frustrated that
increases
home prices have
inflation
still stayed so high
quicker
as rates
in the
have
short
been
term,
high.
because it
What do
immediately
you say
puts
to
money
those households?
out
Well,
in the market
what I can
versus
say
just
to the public is
decreasing
that
cost of capital.
we had we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off.
And you got to understand, they're not really doing QT. They're just doing balance sheet runoff.
Experience as
so
pleasant.
Is that QT kinda? But they're not selling the long bonds that they own.
Low inflation
I just think that they should be
price
buying
stability
long
restored.
bonds here.
And a good definition of price stability
it would
is
keep
that people in their daily
curve
decisions are not thinking
artificially
about
suppressed.
inflation anymore. That's where everyone wants to be, is back to
the curve.
What's inflation.
Not at this
just keep it low, keep it stable. We're restoring that. So what we're going through now,
what we really need is the next time we get low interest rates
a long period
is to do a 50-year
price
bond.
stability benefits everybody over a long period of time.
I don't
just by
buy into the
virtue of fact that
40-year
you're gonna have to
mortgage,
deal with inflation.
but I
So
really
what's been
think that a
going on.
50-year bond would
And
be
I
good.
think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Yeah, real weekly wages under Biden are down 3.5%.
Hi, Chair Powell. Greg Robb from MarketWatch.com.
Sure
I was
do have
wondering
high
if you could go
prices.
through, you said just at the beginning that coming into the blackout,
I think the markets do very well.
there was like an open
for the rest of the
thought
year.
of 25 or 50.
Could be
The
6,000.
Fed could move either 25 or 50.
This next month is
I would sort of argue that
the least confident
when we had those two
I
last
am of the
speeches by
remaining
Governor Waller
4.5.
and New York Fed President John
3.5.
Williams, that they were sort of saying that maybe a gradual
3.5.
approach was going to win the day. I mean, I sort of want to ask a 7-part question about
The yield
this.
curve is uninverting
I mean,
again.
could you talk? Would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Jay Powell essentially said he doesn't care what the market
Thank
thinks.
you, Chair
He's
Powell.
going to do
Simon
what
Urbanovich with The Economist.
he thinks is right for
you
the
mentioned
economy.
how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less
But I have
reliable
to.
lately because of
I
the
have
big
to
downward
think that
revisions.
he doesn't
Does that put your focus
want to
overwhelmingly on
surprise
the
the
unemployment
economy.
rate? And given the SEP projection of
If you have time,
4.4
can you give me a quick
basically being the peak
explanation
in the
on
cycle,
coupon
would going above
on
that
the
be the
bonds?
kind of thing that would
It would be
trigger
easier if you
another
come over
50
to
basis
YouTube.
point
Can
cut?
you do that for me?
So we will continue to
YouTube
look
is
at
ending
that
17.
broad array of labor market data, including the payroll numbers. We're not discarding
I can
those.
show you how.
I mean, we'll certainly look at those, but we will mentally tend to adjust them.
Yeah, so once you come
based
in
on
there,
the
I'll do better.
QCEW adjustment,
But
which you referred to.
essentially, the
there isn't
coupon
a
stays
bright
the same.
line.
It's the
You know,
bond
it
price
will
that
be,
changes.
The unemployment rate's very important, of course, but
For
there isn't
new
a single
issues,
statistic or a
coupon
single
changes.
bright line
But I'll show
over
you
which
some
that thing
bonds.
that might move that would dictate one thing or another. We'll look at each
Let me
meeting.
know when
We'll
you're
look
in there,
at
Chuck.
all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our
And again,
policy
guys, I think my live's
stance
much better
where
on
it needs to be
YouTube.
to
You can see
foster
my
over the
screen.
medium
You can
term
listen to Jay Powell.
our mandate goals. Yeah, so I can't say we have
That,
a bright line in
well, I'm only at
in mind.
3% on my computer. That's not good. Okay, I got to plug in.
Thanks, Chair Powell.
It's
Navigate from
NNEMIT
CNN.
17. Go to my
I know that you
profile,
discussed earlier how
go to my
the
link
Fed
tree,
does
and click on my
whatever
YouTube.
the right thing is, and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office
You just
as
go to
opposed to
Google
people who are not in
NEMA
office.
17 YouTube,
So
it'll pop up.
that's the idea, is that
But it's also in my
I
link
think the
tree in my
data
bio.
are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his
I tend to
views,
think the
changes
president
involved
should
with
be
the
allowed to
endgame.
comment on Federal
Wondering
Reserve
if
policy.
you are in alignment with
Because
him
ultimately
on
they
those
wear
changes
what
should
happens
be,
to the
if those
economy.
have
Now,
support
if they
from
say
the
lower
board
rates
and
and
broad
inflation
literature
goes up,
before,
you
and
can
I
hold
think
them
the
to
other
that.
agencies are also fully on board with
Love
that
yourself. You got
approach.
50 points too
And
fast
then,
to the cut.
yesterday,
I mean, I think
other
we should have cut
banking
25
regulators-
bips
You know what,
in
hold the second
July.
question. Let me we'll give you the second question. So the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea
Chuck.
that we were going to
Let's look at-
repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
For that,
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
So we'll just look at.
And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today.
It really doesn't matter what we look at, but. Okay, so Hungary 3.
Thank
This
you,
was
Chair Powell.
issued in
Jennifer
2018.
Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though
So again,
the
if this
policy
was
statement
a
says
US
you view
bond,
the risks
would be
to
the same
inflation
thing.
and job
You
growth
can see the
as
price
roughly
changes.
balanced. Given what
But
you
this is
said,
locked
though,
in.
today, I'm curious, are you more worried
No
about
matter what,
the
you're
job
going to get
market
paid
and
6
growth
every
than
quarter,
inflation?
probably.
Are they not
You get
roughly
paid
balanced?
1/4 of 6
No, I think,
3/4%.
and we think they are now
So the
roughly
coupon
balanced.
stays the
So if you
same.
go
What
back
changes
for a long time,
is
the risks
the,
were on inflation. We had a
price
historically tight
of the
labor
bond.
market. Historically
This is
tight.
already
There was
issued.
a severe labor shortage.
This was issued in
So
2018, so
very,
now it's selling, right?
Very hot labor
It's
market, and we
this
had
is going
inflation
back
way
until
above target.
2023.
So,
We can
that
go back
said
further.
to us, concentrate on inflation, concentrate on inflation.
So the
And we
price
did
of this bond
for a while, and we
used to be
kept at that.
130.
The stance
It's
that we put in
issued
place
at 100.
14 months ago was
So
a
if you
stance
pay
that was focused on bringing
136
down
for
inflation.
this,
Part of bringing down inflation,
then you
though,
get
is
6% per
cooling
year.
off the economy
And when it
a
matures
little
in
bit cooling off the
2028,
labor
you only
market.
get 100
You now
back.
have a
That
cooler
is
labor
considered
market
your
in part
yields.
because of
So
our
you take the
activities.
$30
So
you're
what
going
that
to
tells
lose,
you is
and
it's
then you
time to
calculate
change our stance.
how
So we
much
did that.
you're going to
The sense of the change
gain.
in the stance is that we're recalibrating our
So
policy
the yield right here
over
is
time
probably 4%,
to a stance
3%.
that will be more neutral.
The yield to
And
maturity.
today was, I think,
If
we
you buy
made
it
a good,
at 80,
strong start on that. I think it was
then your
the
yield
right
to
decision.
maturity is
And I think it
probably
should
more
send a
like
signal
10%
that
or
that
12%.
we're committed to
So
coming
that's
up
how,
with a good outcome here.
as bond prices go down, yield goes up.
to a
As
shock
bond
now
prices
that
go
could
up,
tip it
yield
into
goes down.
recession.
the coupon
I don't
stays
think
the same.
so. I don't. There's.
I mean, obviously.
Well, let me look at it this way.
What the yield
I
says,
don't see anything in the economy right
essentially,
now
is
that
how much
suggests
a new
that
bond
the
would
likelihood
pay
of a
on
recession,
coupon. But once the bonds are
of a
issued,
downturn is
coupon stays
elevated.
the same.
Okay, I don't see
getting
that.
smashed.
You see growth at a solid rate. You
Yeah,
see
the
inflation
20-year.
coming
Let's
down.
see.
You
Let's
see a
see
labor market
TLT.
that's still at very solid levels. It's so I don't really see that. No, thank you.
Inflation is still above where it needs to be. Not much. Not much.
Okay, that was Fed Chair Powell.
And again,
Following
we're
the decision
still
to cut interest rates by 50
very
basis
restricted.
points. Perhaps a bit of a surprise today. Chair Powell saying moments ago, you heard it in the news conference, that there is greater confidence that inflation is moving closer to their target, that the labor market has cooled, but that the economy remains strong overall. Did
I answer your question, Chuck? Are there any auxiliary questions on that?
A position of that stature since 2005. Stocks have been a bit volatile following the decision. We can take a look now. We are higher across the board. We'll track it, of course, over this final stretch. Welcome, everybody, to Closing Bell. I'm Scott Wapner. We're live today in downtown Los Angeles.
So now that, J-Pow can't say nothing, Gundlach is coming on. Okay, I'm turning the volume up for Gundlach.
Nice to be here. You said yesterday when we spoke 50 was your call. That's what you thought it was going to be. Now we have that. Now what's your reaction today?
Obviously, I'm not surprised
inflation.
It was going to be 50. I thought it was interesting that later in the press conference,
I would rather
Powell admitted
inflation be
that
5% every year, and
maybe
nominal
could have gone in
GDP
July.
be
I
7%.
remember when we met 6 weeks or 7
Because
weeks ago.
companies
at
I
the July
invest in have
31st
pricing
meeting,
power.
I said, I
But
think
I'm
they
listening to
should cut.
Jeffrey Gundlach now.
And
Hi,
what
Ash.
probably spurred my
Welcome
confidence
to my
that this
live.
cut was coming was since July 31st, the 2-year Treasury yield has dropped by more than 50 basis points.
Actually,
it's changing.
be my
There's a lot of volatility
subscriber
in
on
rates today too after
YouTube.
After this Fed meeting.
What do you make of that? Why are rates up today, you think?
But don't look
well,
at old
the short
videos.
end is down. Well, it depends what minute you look at it. I'm taking a quick look. I guess it is up a little bit in yield. It did initially rally.
Yeah, like two. I mean, I can look at it now as we have this conversation. 2s, 3s, 5, 7, 10, 30.
Yeah.
They're all those yields are up. Why?
Yeah, they're all up. Well, I think that the bond market at the long end is
yeah,
in particular
TLT
where
is
the yields are up, and the long end of the bond market doesn't want the Fed to be easing aggressively, because they're worried about inflation. The rates have come down a lot this year on the short end, not very much on the long end, and that the Fed easing strikes the long end of the market as being inflationary, and so they're building in a premium against that. I think the word of the day was recalibration. He said it a lot of times.
Well, love yourself.
That,
Are you on?
The rates.
I get that,
he
right?
seemed
Like,
to relax.
as
To me, he even
average
cracked a couple of
American, I would
jokes,
say the same
which
thing.
you don't
But
see much from Mr. Powell. I think he felt good.
Are you
that
on
he was
fixed
now more
income?
in sync with the bond market.
Because if you're
The
not
bond
on fixed
market
income,
is very
your wages
flat
should go
in
up.
Yields from 2 years out to 5
Your
years, even 10 years. It's right about
assets
350,
should go up,
which to me suggests
and it
that
forces
the base
people
case is the terminal rate for
to
the Fed
invest.
funds
So
rate,
I would
given
love rich people, instead
current
of sitting in
circumstances, is
bonds,
350.
to be forced to
And
buy
interestingly,
equities.
they sort of said at the end of 2025 they think they'll be at about 350, and so he's now very much in sync with the bond market. And I think he was uncomfortably out of sync with what was going on, particularly with the 2-year Treasury, which I always say the Fed follows the 2-year Treasury, and they really had to do 50 to get more in line with that pricing.
You've made the argument, and you did again with me yesterday, that the Fed's behind the curve. The chair himself was pretty emphatic that he says we're not. Your reaction?
Well, now they're not so far behind the curve. I think they are a little bit, because they're still up at 4 7/8 on the middle of the Fed funds rate, and the bond market's down at 350. But it seems to me that they're very open to keeping this process going. It's interesting that the next Fed meeting is after the election. Usually it would be before
Come on to
the election.
YouTube.
I think they punted it a week. So they'll have
my
a lot
YouTube live,
more
if you
potential
want
to
to see my
cut
screen.
50 in November than they would have if it was right before the election. Then it starts to, I don't really put much credence in this idea that the Fed is thinking about elections. Jay has said that repeatedly. I actually take him at his word. But I still think it would be rough if you did it 2 days before the election and had a 100 basis point cut.
The Fed is, I think it's fair to say, never really been in what you might call the insurance business, right? They're data dependent. They react when the data suggests that they should react. Was today a bit of an insurance policy?
Yes.
By doing that? Because he noted multiple times the economy's basically fine, he said. The economy's solid. He went on and on about that, and multiple times.
he used the words risk management more than once. And that strongly suggests an insurance policy type of mentality, at least partially, because he knows that the employment rate, the jobs that are reported the first Friday of the month, he admitted that they're artificial.
Where's
He actually said that
Bradley? I
today,
want
that
Bradley
there's
in this
something
live
artificial
because he
about
has some
them because they
TLT
keep
puts.
revising them lower.
He thinks it's
there was
going
that
to 90.
monstrous
It's at 99.
818,000 jobs on the revision, and it seems to be happening consistently. He said, we'll make a mental correction now on the first Friday of the month they come out, which would mean about, just think of it as being 75,000 jobs overstated. And so I think if we get to an employment report that's at 100,000 jobs, that's going to be a real danger signal, because if you clip 75,000 off of that, you're getting down, you're starting to fly the plane near the tops of the trees. And also, I want to point out, as I always do, that the household
payment
survey,
of interest,
which is also an important survey, tends to be more accurate.
So again, yeah. So when you buy a bond,
full-time job growth this
the
year,
coupon you get
January,
is going to stay the same.
8 months. Negative job
but the
growth.
price is going to
And
change.
The part-time
So
jobs
the
are
yield
almost zero.
to maturity
So
changes.
the surveys do not really jibe with one another, but they're clearly weakening.
Because you're going to get $100 back for every 100
is
you
weaker
put
than
in.
the Fed chair himself just said?
So if it's trading at 90 and you get 100, that's a little bit of a return.
And it's backward looking.
Depends on how long
the present data,
that
which is
takes.
backward looking, supports
like if
the
it's
statement
trading
that
at
the economy
90
isn't
and it's a
showing
10-year
signs of
bond due in
significant
9
stress.
years.
And GDP now, the most recent cores of GDP,
getting
they're showing up at about 2% real, which is
11,
pretty
12%
solid growth. I mean, it's the
more
growth
money in
that the
10 years
the
isn't
CBO
doing
uses
much.
to make their predictions into the future.
9 years.
But I do think that
But if it's trading at
interest rate
90
problem
and it
with
comes due
credit
in 2
cards
years,
in the economy
that's
is
like a
significant.
4%
I think the level
boost
of debt
to whatever your
on the
coupon
consumer
is.
is very high. And
4.5% boost to whatever your
see
coupon is in
weaker
terms of
economic
yields.
data in the coming reports. I still think there's a good shot that the history books will say September 24 was the start of a recession.
Steve Leisman's come out of the room. I want to bring in our senior economics
reporter. Let me know
reporter.
what TMF means, though.
Steve, how close of a call was
Am I
this
tremble?
really? The Fed chair used the words broad support for
Am I on? Are you talking about trend? Do I look like a trend twins to you?
Since 2005,
Come on now.
at least somebody of that stature.
Yeah, my old good friend Mark Olson, who dissented in favor
Bitcoin.
of an easing of
I
policy,
love
which is what
Bitcoin.
Fed governors typically
Yeah, it's my
do.
favorite.
We haven't had one dissent in favor of tighter policy
asymmetric bet
in a while
right now.
here. Scott, I want to bring your attention to the word recalibration and maybe a
I'll pull
discussion
Bitcoin
about
chart up
what
here.
that means here. The chair used the
I'm gonna
phrase
do it
about
through
5 or
ARPA.
6 times in the press conference. It was part of his opening remarks. And I asked him the question, how can we know, given that the data has been reasonably strong, actually running near 3% on the GDP tracking forecast for this quarter? Retail sales were strong. Industrial production was strong. So I asked him, how can we know what you're going to do? And
the
this
rate
is what
cuts
he
help
said, and I'll give you
Bitcoin,
my
but
thoughts
also
on
the
this on the back
election
end.
could be immensely bullish for
You'll
Bitcoin if
see
you
that
believe Trump's going to win.
It's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time.
So what you're doing here, Scott, is if you're recalibrating policy,
Again,
you're
the reason why I'm
almost in a
not
way
speaking
disconnected
constantly
from what
on
the
TikTok
current
is
data
because I'm
is telling
listening
you. And
on
it means
YouTube.
you're going to go down, and you might go down in what Jeff is talking about, 50 basis point increments. If the inflation data is a little higher, if the jobs are a little higher, you're recalibrating to get to a place where you can respond to the data. But if you're way high, which is what the chair is suggesting here, you can't respond to the data adequately if you're way off the marks. You got to recalibrate and bring it back. And I think that's where the Fed is going. And that's why I think I agree with what Jeff is saying. I disagree on the issue. I think he took a little bit more, I don't know what to say, it took a little more signal from that job revision that perhaps was warranted, in part because, as Goldman suggests, there may be an immigration issue with that data. That being said, we're recalibrating now, Scott, and that means we're not really following the data quite as closely as we might to figure out what the Fed's going to do.
Jeffrey's nodding his head as you're talking because there's a simpatico between the two of you and the way that you viewed this today with that word, because it's the first word that Jeffrey mentioned.
Oh,
right?
Thanks, man.
That's the thing that caught you most of all, just like
Summarize what
just like
happened.
Steve
Yeah,
was
the
now. So
Fed
stay with us, Steve. I
cut
want
50
to
basis
to
points
answer.
That's the word of the
instead
day
of
for sure.
25,
I think
which was,
I got the
what a lot
feeling
of
that
people
Jay
were
Powell
expecting.
was
Jeffrey Gundlach
getting
is talking
quite
now on
confident
CNBC. I'm listening to
about
that
the
because
inflation
he
trend.
called this.
Our inflation model, which uses shelter and
But yeah,
price
that
of energy
means
pretty heavily,
we're getting closer to
suggests that the
neutral
inflation
quicker.
rate on the headline CPI,
So does that mean that the
within
economy is
about
doing
5
worse
months
than we
from
thought?
now, will go down below
I don't really buy
2%.
that, but I think the narrative
And
could
it'll
be that.
depend on what happens with the commodity complex in those ensuing months.
It's
But it
just,
could
it's
stay
Fed
below
speak.
2% for quite some time. And the
A
commodity
lot of trying to
complex
thread
is
the
strongly
needle,
supportive
trying
of
to
that.
land a
The
747 on an
commodity
aircraft
index is
carrier.
below its 50, 100, 200-day moving average, all three of
So
which
if
are
we get a
falling.
soft landing,
And
for
it is
sure,
interesting that with the dollar
that would be
having
really
lost
exceptional.
about 4% in value since the last Fed meeting,
But we'll
that
see.
the commodity complex is showing no signs of life at all, and the price of crude oil is hovering around $70 a barrel, with signs that it might break to the downside. So it could be interesting to see how low the inflation rate goes. I feel that one should not be worried about near-term inflation, but one should be worried about longer-term inflation. And that's what's got the long end of the bond markets a little bit concerned. Because when the economy rolls over, we're starting from a deficit of nearly 5% of GDP, and it's going to go up a lot. And that means a lot of bonds. And will we have a change in the pattern? And I'm quite open to this idea, though not utterly convinced, that at some point in the recession, the fiscal and monetary responses will lead to the long end of the bond market perhaps going up in yield. And that could be sort of being signaled, even though it's for just the last couple of hours, by the action today.
Steve, lastly, to you, and
NVIDIA,
you made this
let's
point,
look
I
at
thought it's
NVIDIA
interesting.
today. Come over on
some of the criticism
YouTube
leading
so you can see
into
my screen.
today has been that the Fed's been too data dependent. Your suggestion with the move today of 50 basis points,
you probably know I love,
is in fact a break from that.
I love NVIDIA.
Jeff and I talked
Do I think it's
about
going to be the
idea
highest
of an
performing
insurance
asset
policy,
over the
that the
next
Fed really
12
isn't,
to 18 months?
generally
No, but I
speaking,
think
in
it's
the
a
insurance
$200
business,
stock.
but
And that would
maybe
add
that's
$2
what
trillion
today really was.
to the
So,
market cap,
Scott,
the stock market.
That's
And
a
if you
right
add $2 trillion
observation,
to
except
NVIDIA,
for when the
you
Fed
probably add
essentially
another $5
in
trillion for the
neutral
rest of
and
the
trying to
mega
balance
caps,
and fill the way
and maybe another
as to
$4
where the
trillion
right
for the
neutral
rest of the
rate
market.
is,
So,
then it
we
ends
could
up
be at
being an insurance
7,000
business in
SPX.
terms of essentially getting policy to the place where acting on the biggest risk. Remember what Greenspan used to say? Guarding
NVIDIA
against the
basically flat
low
today.
probability, high risk event. I think that's where Powell is right now. And by the way, Scott, we may end up, I hope Jeffrey's wrong here. It's a bad bet to bet against Jeffrey. I'll acknowledge that about the recession having begun. We may end up calling this, if he's wrong, the immaculate 50 basis point rate cut. And I'll read you what Powell said here. He said the U.S. economy is what this means, U.S. economy is in a good place. Our decision today is designed to keep it there. The economy is growing at a solid pace. Inflation is coming
Trying
down
out the
closer
VWAP
to a
to see what the
2%
VWAP on NVIDIA is.
objective. The labor market is still in a solid place. If we end up being okay here, this could be the only and the first ever immaculate 50 basis point rate cut, Scott.
Yeah, Steve, thanks so much. Our senior economics reporter, Steve Leisman. It goes to what
what they're saying
Claudia
now
Sahm
is
said
like
in the
the Fed has
hour
never cut
preceding
50
the
basis points and
decision
never
that
gotten
the
a
Sahm
recession.
rule says we're in a recession already, as you've been suggesting.
Now we're
as well.
talking about the
Sahm
Sahm
herself
rule.
says we're not.
Well, I guess she's
Even though
violating her own
Sam's-
rule, but I use something that's similar to the Sahm rule. It's simply the unemployment rate relative to its 36-month moving average. And we're observably, convincingly above the 36-month moving average. And there has not been any experiences where you've made that crossover without a recession. And so I'd watch out for that. You know, on this insurance policy,
Commercial
thing, you
lending,
see these ads
commercial
on TV
real
where
estate.
somebody says,
I'm not a
"Oh,
real estate guy, but
our friend out of
I gotta,
he's only 47.
um,
They say, "Do you have life insurance?"
I gotta
The guy says,
imagine
"No."
that,
He says, "Well, you better get on it." I
moves
think
are going to be
Jay
made.
seemed
I don't know
relaxed
what it's
today
going to do to
because
prices.
he's somebody
They
that
come
didn't
down a
have an
lot in the
insurance
commercial
policy yesterday,
side.
and now he has the insurance policy, and
But,
he feels comfortable about that.
sellers are
And the
probably
recalibration
been
is
sitting on
absolutely
apartment buildings.
appropriate
Maybe,
because he's right.
they bought them for a
I
lot
thought
more than they can sell them
one
for
of the best
now, but are
points he's
finally
made
thinking this is
ever
the
as
best we're
Fed
going to get.
chairman was
Conversely,
comparing where they were with the
buyers are
inflation
like,
rate
okay,
up
we can
well
now
above
see
their target and the unemployment rate in the mid 3.5s. A
rates
restrictive
going down,
policy
so we can
is a
take
no-brainer
this
under that sort of set of circumstances.
five,
but that's
maybe a
not where you are anymore.
5-year
and I think
borrow
it was a very wise way for him to to make that
pay
point.
that for 5 years, and in
it,
5 years
it set the
we're going to be
stage
lower.
and,
Or
really
if it's an adjustable rate, which
offered
commercial real estate I
very
don't
good
think
rationale
usually has.
for why
Actually, I
50
do think it
and not
has
25.
The
a lot of
projections
adjustables.
suggest 100 basis points this year.
I don't know
Remember,
how it's going to lead
projections, the
to
so-called
prices
dots. You've said you think
for commercial real
125.
estate.
Where will we be, do you think,
I just
by
think
the
that
end
the
of the year
volume
on that?
is going to
I
pick up
think
for sure.
we'll probably get another 75. So it'll be down 75 from here. So
So
down
you'll
at
stay
4
with
and an
that.
eighth, about 4 and an eighth.
There are dangers on both sides.
If
I
I
mean,
had
I
$100
bet you're
million,
acknowledging
I would
this
not be
as
putting
well.
it into
It's,
commercial
you
real
move
estate.
too fast, you risk
Let me answer your
reigniting
question
inflation. You move
that
too
way.
slow, you risk then tanking an economy that he says himself looks pretty good. How do you see the balance of those risks?
I think that the
The
interesting
next month
question
and a half
about
until the
what
end
this
of
Fed policy is
October,
going to do
I could see
is
you.
what's going to happen
There's 3.5 months
to
left in the rest of
housing
the year.
market.
I'm
Is it
least
really
convinced
going to
about that,
stay
even out the
firm?
next 6
Is
months,
it going
like
to
this
go up
first.
because of
But
potentially lower interest rates?
does
Or
that mean you
is
should
it going to unlock supply
have no
if you get interest
stocks?
rates into the high
Certainly
fives
not.
on mortgage rates? Will that unlock supply of people who've been wanting to move? Will it help the economy? Because some of these people
Many
who took
people
out
have taken
mortgages
haircuts over the past
a
year
year or two
selling,
ago might be
since
able to do
refinancing makes no sense.
some rate reduction and monthly payment.
I agree,
think
but
that's
I
the
just
real
have to think like they're not
wild
selling
card
as much
for
as
the
they could because
inflation rate and the
the
economy
prices are down.
is
They're
what
only selling
happens to the
because they
housing
need
market.
to.
And I don't think any of
Now
us
they might be
really
selling
know. And
if
the
they
reason
need to,
is
and
that we've
if they
always
want to.
experienced
If they don't
lower
really like
rates during
their
recessions, and
portfolio right
we
now.
have not had in hiking cycles such strong housing prices. So will they go down if they cut rates because of unlocked supply? I don't really know the answer to that, and I'm very anxious to see the data as it develops. For now, I just think the inflation risk is lower than the unemployment rate and the employment risk and the economic risk generally with the consumer.
What do I do as a credit investor? Now let's switch to how to put this into action today.
A
lot of people are thinking about that now.
Last
it is
meeting
going to be
I
interesting.
said that you should go from floating to fixed, which is the first time I said that in a long time because I said the Fed's going to start cutting rates, and certainly that's been a good call. I mean, one of the best performing asset classes since the last Fed meeting and the one before that is actually long-term Treasury bonds. So I think that credit spreads are very, very tight. It depends what index you look at. There's one from Bank of America. There's others. And the high-yield bond market got on one of those indices to a level of 280 basis points of excess yield over the 10-year. It's kind of quietly gone to 320. So they're already starting to widen, which is another reason why I think that underneath the surface of the economy, you have to be careful. Because when credit spreads start to widen, that's a sign that things aren't all that copacetic. Also, I'll point out that the 2s, 10s yield curve is now
Lowest
it's
price
no longer
prediction.
inverted.
Yeah,
And
I think
when you
that
get near the front end of
102.
the
What did they
recession,
get to?
it's
102.
not so
I
much
think
that it's
that
inverted
was
that
the
you
low,
at the front
recent
end.
low.
It's when it has been inverted,
You
particularly
know,
for a long time,
like
and then it
if you
de-inverts.
do you have an
Well,
Nvidia
that's
position?
happened. And we were
Well, it was in
inverted
the
for a
90s in
couple of
August.
years on the parts of the yield curve. Also, remember T-bill and chill? Everybody liked the 6-month T-bill at 5.5%. Well, I said don't do that because you're going to wake up one day and it's not going to be at 5.5%, and pretty soon I think it's going to be at 4%. So the intermediate part of the credit market is still good. I mean, the middle tier of the capital structure, not the junkiest stuff. I prefer fixed over floating. And now with the dollar weakening, it might be time to start upping emerging markets. And if you're really intrepid in local currencies, I'm not convinced the dollar is going to accelerate to the downside, but I will believe that if we get 2 closes below 100 on the Dixie, and we're basically at 100.5, so we're not very far away. So the currency play might start to get
You sold
really
most of
interesting
your
for dollar-based
Nvidia.
investors.
What did
told me
you sell it
yesterday
at?
you went from a maximum long
Hopefully
on
140.
long-term treasuries, that you cut that back a little bit in recent weeks.
Yes.
What do you do from here then?
Well, rates are kind of stabilizing. They're at a not so attractive level anymore. When you could get 5%.
Nice, 137. That's a good exit. Yeah, I mean, listen, if we get below 110,
we're at 3.5.
that's a good trade. You probably paid taxes, but I think you're covered.
Not so much.
And I would start because I think it's a $200 stock.
At the long end of the market,
It's a Papa
which had
cookie.
been good for part of the year, but rather the relationship
108 's a
between
good buy.
short rates and long rates, which has changed from 2s, 10s by 115 plus basis points since we were at the maximum inversion. I think that's going to continue. I think we're going to get the
100-day moving average is at 113 though,
150
so
basis points less than the long bond. So there's still a long way to go.
I don't
that's
know
sort of a trade.
I mean, that's pretty close. We're at 114.
It's odd. You're actually taking a more
I don't think it's a terrible time to buy NVIDIA at 114. Again, 12 months out, I think it's $200.
A less optimistic view of the long end. So it's really weird.
But again, I'll just make this statement again.
Your duration and
if NVIDIA is $200, there are going to be bigger winners. Sure, that's going to be the biggest market cap add. It's going to generate the most wealth for Americans, the economy, investors, what have you. But also, the other mega caps have to be up at least $5 trillion.
This idea that you would think because
small caps, medium caps, they have to be up like $4 trillion between them.
The curve would continue.
So there are going to be some small caps. Do I think it's Palantir? No.
On the longer end, certainly you could have.
But I think there's potential for 5x
the cost of funding the deficit
lower down in the AI trade.
Long-term interest rates on
what they are,
Treasury,
I don't know. I have some ideas. But that's really like the biggest question I ask myself. What is, if NVIDIA's 200, what is going to be the biggest winner? AMD could be one. That's a pretty big, that's a big cap.
Positive for the long bond has been in play all
but it could
year,
be, 200, 300, 2 or 3x. So but that would be amazing.
The problem
especially if you play with
options is that our responses to
I have a small position in my main portfolio.
Yes,
but my mom
very
owns a lot of
unusual. We hope we
AMD.
don't have a repeat
Good
of
amount of
something like
AMD.
that. But the amount
Not as
of
much as
money that
NVIDIA.
they were
NVIDIA
willing
and
to give
Apple
away
are her biggest
is
positions.
a
Apple
cautionary
is
tale
one of my
as to
biggest
what might happen
positions.
when the next
NVIDIA
recession
is
comes.
up there.
And that's my thesis as to why long rates.
But I think
might
I get another
actually,
10 shares.
After the
Which
initial
is
Pavlovian response coming down,
$1,100 Christmas present. That's pretty
not
sweet.
insignificant extent, that may
So
get
I
rejected
consider that part
and
of my
rates may
holdings
start to
trading.
go up. And that would be
High 90s before
that would
the
be
end of
a
the
real
year.
trap.
So do you
I mean,
really
even have
think
like a failed
after the
auction or
election
something. Remember when that
the
happened
market's going to do poorly?
in the
NVIDIA's
UK,
going to do
and
poorly.
the long bonds went
Also,
up 100
this
odd
Q3
basis points in a day.
for 2025
I think we
comes
have a
out in
chance of that
November.
happening if the
I
policies
think
are
that's a
handled correctly.
blowout.
But it's
I
gonna
think
be
the market starts
fascinating
sniffing
to
that out.
navigate through this because none
So-
of us know what it's like to have a big bear market in bonds, start from a level, and then will they drop during the recession? Maybe they won't. Where will credit spreads go during recession if, say, junkier borrowers don't have the ability to refinance during recession?
So they
which
gave guidance
had
for
historically,
32.5
because rates
billion
go down. Even though spreads widen
for
during
Q3.
recessions, the base rate, the treasury
I think it could
has
be
always come
36
down
at
quite
least.
substantially. I'm of
You know,
the mind
34 and
that
a
that
half
might
is
not
probably
happen
what
this
the market
time. And so
expects
there could be
because
a lot
they've
of
beaten by
companies that
$2
are
billion
trapped into
pretty
fixed
much
rate
every
debt.
single quarter of the past
Thankfully, there's
8
you
quarters.
see CFOs are smart. They
Each quarter.
locked in very tight spreads and very low rates back in 2021.
At least.
And they extended maturity. So,
So
it's-
34 and a half, I
thankfully,
think it could be
it's not
36.
an immediate problem.
Could be
But
up
it's
to
kinda like
38.
the rent data or the shelter data in the
There's
CPI.
surprises
It's
down
sort of
every
like
quarter.
We see the new rent rolls.
Oh,
are not that robust.
okay.
There's
I see what
actually
you're saying.
Parts
I mean,
of the country where
they still
the
had
new
a.
tenant rents are declining.
They said
It takes a while for the
28
old rents to
something.
kind of get to their roll level.
They
and
beat by
roll
like
over.
1.5.
So I think we have
So that's,
potentially coming our way in 2025, sort of a tailwind on the shelter component
5%
coming
beat,
down.
6% beat.
CPI.
I just
Jay
think that
Powell
it's going
kind
to
of alluded to that
re-accelerate
too.
next
He
quarter.
seemed quite
The
aware
quarter-over-quarter
of this
growth has dropped, but
differentiation
it's still
between
15%.
new tenant rents and rolling of old tenant rents, and it's happening at a rate.
If you
that is,
annualize 15%
that's
over 4
shorter,
quarters,
the
quarter over
timeline
quarter
that
versus
is
year over year,
more
you get
extended
75%
than
growth
most
per year.
people, I
That's
think,
insane.
are used to assuming when they look at the rent levels.
And what
of
you have to
shelter.
really ask
So
is like
that's another
less
reason
so
why I
like
think
what is the
that
growth rate, but like
Fed
what
is comfortable.
can
much more-
NVIDIA
much-
do in the long
He
term in
says
terms
he's
of
balanced.
business?
Use that word
This is
over
like
and
what a
over.
VC
What I
investor
heard
asks.
was
Like,
we're more worried about
how big is the
employment
market?
picture
How
than
much of the
inflation.
market
Oh,
are
sure,
they
and I
going to
agree
get?
that he's right
You know,
on.
NVIDIA
You've made the
has a
argument
massive
that,
market cap, but like how
if
so
people assume
their market
that
shares,
it's going to be, as
it's
some
not going
have
to grow.
even suggested that this is going to be a golden age for fixed income,
Except maybe
because of the
marginally.
trajectory
But how
of
big is
rates,
that
that it's
market
more
going to be? we have $1 trillion in data centers now. If that's $5 trillion in data centers in 3 years,
I mean, the golden age for fixed income was a year ago.
could
when
that be
spreads on high-yield
$600
bonds
billion
were
a
500
year
over, and the base rate was at 5%.
in terms of
You
revenue
could get
for
10%
NVIDIA?
if you
It's possible.
underwrote your credit risk prudently without really trying all that hard. But now fixed income rates are
I mean,
down
I think
around
you can
3.5
pretty much
on
count on. I'll
treasuries,
pull up
kind of,
NVIDIA
for
here.
most of the curve, and we
I'll
got
see what the
spreads have
consensus has
widened, but
done,
they're
and then I'll
still
show you
only
how the
320
consensus has
basis
gone
points
up.
on junk bonds. So you've gone from 10 plus to 6 3/4, and the spreads have started to widen. And so I think credit is still fine in single
Low of the
A,
day in
double,
S&P.
triple B, strong double Bs, maybe even some strong single Bs. But
Oh
you've
yeah,
got to be
TMF is the
careful on
30
where
or
you are on
20.
the
Just
curve,
buy the
and you want
TLT,
to make
but
sure that you have
do not buy those
companies
leverage
that
products.
don't
Sorry,
have
I don't know if you're still
rollover
in here.
risk in the very near term.
You've raised a lot of eyebrows, I think, yesterday when you suggested that private credit is a bubble.
Yeah.
Do you want to expand on why you think that's the
180
case?
now.
Trillions, it's a trillions of dollars asset class at this point?
Yeah, private credit is a very cyclical asset class, and it usually gets to a high valuation and a lot of overinvestment when you can look at public markets and find that they're not very attractive by traditional analysis. So for example, starting 2022, in my Just Markets webcast, I pointed out, this was right at the local top of the S&P 500. I pointed
Goldilocks
out
private
that
credit
using
is a
conventional
bubble.
decades-long data series of valuation on the S&P 500, so PE ratio, cyclically adjusted CAPE ratio of PE, price to sales, price to book. There's about 25 of these things that you can look at. And versus its own history, forget about other asset classes, just where these valuations were versus decades of the S&P's history, the stock market was really overvalued versus its own history. It was top percentile of PE, CAPE PE, top 3 percentile of almost all of these 25 data analyses. But weirdly, as overvalued as they were relative to the internals of the S&P 500, I said in my Just Markets webcast, they're actually undervalued versus the 10-year. So we've got this way overvalued equity market versus itself, but it's actually cheap to the 10-year because you can compare the 10-year yield to the inverse of the PE, which
So
is
now
called
I'm
the
looking at
earnings yield of the S&P
2026.
500, and it was below average versus the 10-year Treasury. So I said, this is a bad setup because you've got an overvalued stock market and you've got interest rates almost sure to rise with what we knew was going to be rising inflation from
Revenues more
negligible
important.
interest rates. So what allocators end up doing is they say, well, I don't like the S&P
quarter
versus
three, I
itself.
want annual.
I hate the bond market. It's cheap even versus an overvalued stock market, but rates are going to go up. And so that means that
I think these consensus
stocks
numbers are
will
really
not
low.
have a tailwind. They'll have a headwind of the
I think
discount
we're
rate.
looking
of
at
the
maybe
forward
220
earnings
billion
going
on
up.
NVIDIA.
And bonds are going
And
to take
I
the
think
worst
that's
losses
conservative.
in the history of the bond market, which is what happened.
And then the
So
next
what
year,
allocators end
that
up
could be
doing is they
280,
say,
300.
I don't want to buy the S&P. I don't want to buy the 10-year for sure. So what am I going to do? And so they turn to things
$120 billion of free cash flow. Pretty
things
good.
that aren't so rich in valuation history. And they say, you know what? You're coming to me with a blind pool. You've got a SPAC going on and you're a blind pool, a lockup fund. I'll tell you what, I don't like public markets. I don't like stocks. I don't like bonds. So I'll give you money to allocate to your SPAC under one condition. You don't tell me what you're doing. Because if you tell me what you're doing, well, then I'm going to be able to map over this overvaluation analysis from stocks and bonds, and I'm not going to like what you're doing for me. So they kind of, they kind of hold their nose, close their eyes, cover their ears, and go in, and they hope that it's going to work out. Unfortunately, the promise of a lot of private markets is a little bit of a false promise. It's based upon a Sharpe ratio or volatility argument, which means you get about the same return or hopefully a little bit better than the public market, but you have lower volatility, so you're risk-adjusted in a much better place. That's a false promise because they're not marked to market. They're private. It's like saying you never lose money on a CD. Well, you have a penalty if you want to get rid of it, but they don't market to market. And so I think that there's false promises that go into these non-mark-to-market strategies. And I think every speech that I've given in the past 2 years, one of the very first questions is, what about private credit? And I say, well, I guess you must own a lot of private credit. And they, yeah, a lot of private credit. Well, I noticed at Harvard, when they had their problems with their donors backing away, they've got a $50 or $60 billion endowment. They had to tap the bond market for operating money. because they didn't have enough liquidity in their $50 or $60 billion portfolio of endowment to raise
My YouTube's pretty
$1 billion
delayed right now.
or $2 billion for salaries and for maintenance and so forth. That's telling you a lot, that there's a lot of illiquidity that's built in to some of these large pools. And when they get
So I think I'm
going
going to end YouTube.
Need to get money. Well, they have to liquidate
and
some
then
of the stuff, and it's not
I think I'm going to end
at
my
par.
live here.
It's going to be
So,
a
okay,
haircut.
last
So
questions.
I'd be very cautious about being overly illiquid in our market today, because as the economy transitions, if I'm wrong and it takes a year to get into a recession, it doesn't matter. Once you get to these types of conditions,
NVIDIA's
you
at
have to act. You can't just say, oh,
113.90
everything's
now.
okay. Valuations are
No,
high.
no worries. I'm
Particularly
just
on,
okay. I'll see you. So the chat
magnificent
is
stuff,
updated,
and
but
spreads
for
are
whatever
starting
reason,
to
the
widen.
screen that I'm seeing
This
is
is
pretty
a fun
delayed.
area for active management.
So I
It's
see
great when
it's
rates
not
are
that big
moving.
for
It's
lag.
great when the yield curve's changing. You can start to make some clear
Appreciate that,
decisions
yeah.
on what to do. But I would not
So
be
so the
allocating
sound of
significant money
CNBC at this
these
level is
yield
pretty
levels to
good. It's
long-term
not like it's
Treasury bonds.
I want to ask
between
you
me
about a couple
talking
of
like
other
it's a good weight
investment ideas, but I want to take a quick break.
of
You stay
sound.
with us. We're back here at Double Line with Jeffrey Gundlach. We're going to get Mike Santoli's first reaction to the decision in the market zone, which is next.
So just let me know on that next time how my sound should be. All right, guys. Appreciate it. For next time, please subscribe to my YouTube to help me out there. That's, besides Substack, that's the best thing you can do for me. All right. I'll see you maybe tomorrow, maybe sometime later in the week. I want to talk about specific new investments because I've been making quite a bit. All right. Until next time. See you guys.